Welcome to Trading Strong, Mastering Finance and Fitness, presented by Leo Rising, the performance consulting firm dedicated to empowering individuals to reaching their full potential. I'm your host, Adrian Alberts, and here we explore the captivating stories of traders who have achieved true excellence in both the financial markets and the world of fitness. Join us as we delve into the lives of these unstoppable individuals, where the fusion of financial brilliance and physical excellence creates a powerful synergy. From making calculated moves in the markets to conquering physical challenges with unwavering determination, these remarkable traders have found the winning formula for success. Get ready to be inspired by their tales of dedication, resilience, and the relentless pursuit of mastery. Trading Strong, Mastering Finance and Fitness is your gateway to unlocking the secrets of these extraordinary achievers. So, fasten your seatbelts as we embark on a journey to master both finance and fitness.
My guest today is Mark Serafini, a trader from Boston New York, actually, but he's in Boston at the moment, who specializes in complex systems and volatility instruments. So Mark and I go back a few years. We used to consult for a systematic trading fund in New York, and we used to communicate a lot via email, and he also participated on the daily calls and stuff. So it's actually nice to finally have this kind of chat where we can talk about other stuff too. And this was while I was living in London. I mean, how time has flown, that this was quite a few years ago. And If I might add this though, it's my absolute pleasure to have you on as my first guest for the new Trading Strong, Mastering Finance and Fitness podcast. So without further ado, welcome, my friend, and thanks for being here.
Thank you for having me. It's interesting. It was an interesting concept. When I saw you post it, I said, oh, that's interesting, because it's interesting because the guys that I know on Wall Street, most of them are like golfers, right? There's not a lot of guys who are doing either extreme sports, or some do strength training and things like that. Like Charlie McElligott over at Nomura, I think he does CrossFit. So I think there's some guys that are into the exercise part, but like most of what I did when I was a kid was extreme sports. I was a skate punk. I was the BMX racing, freestyle BMX, motocross racing, and then surfing. And to me, those were all, when I was a kid, I was always interested in taking physical risk. And then, I end up going into a career where I'm taking financial risk. But it's kind of all the same thing. You're always internally, either consciously or subconsciously, calculating probabilities. Yeah. Right. So it's like if you're trying to do some crazy trick on a BMX freestyle bike, you're like, well, I got about 6% probability. If I go too far this way, I'm gonna land on my head. So it's the same thinking. It's just applied in a different context.
It's actually interesting you started off with that, because I actually wanted to know how you got into MMA, because you mentioned that you like doing MMA, and that you also you work with some complex stuff. I mean, some of your posts on LinkedIn, I mean, I've got a reasonably good grasp of the trading world itself, but I read some of your stuff and I just go, oh, yeah, I have no idea what he just said there. So how did you get into this?
Well, I think part of the problem with the business, and that's why nobody generates any alpha, is because they're using classical physics type methodologies where they're using statistics in the historical past, and they're trying to look back and say, oh, well, there's a fixed set of rules that I can look back at, like poker or blackjack, and deduce infer something forward about that. The problem is, the example I like to use with people is, if it rained the last 4 Tuesdays in a row, would you bet that it's going to rain again next Tuesday?
Not necessarily, because recency bias might actually cause you to think that it will.
But it's even worse, because what happens with markets and with weather is there are a set of initial conditions that come together to create that output, right? Markets are the same, right? In markets, if you're going to use something, you could do this in the 70s and 80s, like, use blackjack methodologies and stuff, because nobody was looking for that stuff then. Now there's a million computers doing it at nanoseconds. Oh, yeah. So now you have to understand, what are the initial conditions and how are those going to create some path dependency that's going to move markets? And it's kind of like the rules in poker and blackjack are fixed. The probabilities don't change. Bluffing, you can cloud the probabilities, but they're the same. In markets, the probabilities change based on the actions of the players. So when I'm doing MMA or jiu-jitsu or something, it's the same. It's a complex adaptive system. If I lean one way, he's going to do another thing. And if I want to, like, if I'm grappling with a guy, I kind of want to push into him to see if he pushes back, right? So if I push into him and he pushes back, I'm launching him, right? So it's like there's this feedback mechanism that goes both ways. And I think in markets, a lot of people don't view it the correct way. They're looking at it as if it's something that I can solve. It's an equation I can solve. But you can't solve an equation where the rules are constantly changing unless you understand the context. What are people doing? What do they have to do if price does X or if vol does Y, or if, whatever set of rules that, it's kind of funny because you have so many people doing so many things differently, but having the same result, right? They're buying something because it went up, momentum. Okay, that creates a momentum effect. They're buying something because realized volatility went down. That creates a momentum effect. You have people buying something for whatever reason, and that creates a momentum effect. And then the guys looking at momentum feed back on that and say, oh, it's going up because of this. And you create this network of multiple actors doing things for different reasons, but creating the same result. And then that keeps going forward until it reaches the point where it's saturation, right? Like, it's like a sponge. You can only get so much water into it, and then it just repels water. Same with markets. Once everybody's made that bet, because markets are discounting mechanisms, once you've already discounted the future, and if new information comes in and the market's not reacting self-reinforcing or positively with that, then there's a problem, right? And then you get these things switch and they all go the other way, right? So it's this constant cycle of emergent order, phase transition, and entropy, right? It's just risk on, reversal, risk off. And it's no different in like fighting in MMA. If I'm sparring with somebody and I pick up a tendency, I'm like, oh, well, they throw a right jab, another right jab, and then they're going to come with a left kick. Well, okay. If he's going to keep repeating that, I'm going to take advantage of it, right? Until he changes, and then I send something to him, I fake him, I do it twice on purpose, and then get him the opposite way. So it's this dance of a complex system where everything's always adapting and evolving. And the markets, unfortunately, like to hire people with hard science backgrounds who want to solve an equation.
Yeah, to their detriment, I might add, a lot of times.
Yeah, and it's like, in a lot of the people, it's changing a bit now. It's much more master of science guys and MBAs. But it's the same thing. They're all looking at things from the same point of view that they learned in school, and they all have a CFA, and it's not too hard to figure out what they're going to do. And their reaction functions are very simple. So it's to me, like, I'm fascinated by complex systems that are constantly adapting and evolving. Like, I also do bass fishing, right? You have to figure out what's the moon cycle? What's the wind? Is it sunny out? Is it cloudy out? Where are the fish hiding? What are they going to eat this time? I mean, if it's a day where it's overcast and windy, there's a certain bait I need to use because I know they'll bite that. But that bait won't work at noon on a sunny day.
So the moon cycle has an effect. I never knew that.
Oh, yeah. Oh, yeah.
Wow.
In bass fishing, there's a guy in California, I forget his name, but he routinely catches 10 to 20 pound largemouth bass. He's caught the most in the world, something like 5,000 of them. And he said when he goes out there, if he looks up in the sky and he sees the moon, he's like, I'm not going to catch a big one today. Okay. He's like, I know it's not going to happen because a bass is a predator, and for it to make it to that age, it has to be very sharp. So it's only going to go after the slowest injured predator. You know, he's a predator. The slowest, weakest. You know, he's going to stack his probabilities so high that he's not going to risk it getting killed. Because when he was a little tiny little bass fry, he could have gotten eaten by anything.
Yeah.
Or to get that big and that old, he has to be a very smart fish. So the smart fish know when to do things. When occasionally in the middle of a summer sunny day, you throw something out there, some dumb little bass will bite it, but you're not going to catch a big old one that's been schooled. It's kind of like you're not going to trick a 55-year-old trader, right? They've been doing this for 35 years, 30 years. It's not like it's some kid that just came out of, you know, the PhD program at MIT and he's figured it all out because he ran some back tests, you know? It's kind of similar. So it's, you know, everything I do, I'm attracted by complex system surfing. Another thing, you get this wind blowing off of, these storms come off Japan in the winter. They blow massive amounts of wind and they send waves to Hawaii. My wife's from Maui. I go surfing in Maui every year. And then by the time they reach Hawaii, they hit the reef and they jack up. And it's a weird coincidence where the wave breaks, where the swell, the ground swell is coming in, and then this backwash coming out, and it hits, it peaks up, and then it throws. And it's a weird process, but it's very adaptive. I mean, these waves have been traveling for thousands of miles, and the bigger the storm, the bigger the waves. In Hawaii, the waves get big, and the dudes who surf there are super macho. I mean, they have their own scale to measure waves there, which is half the size of the real wave. They measure the back, not the front.
Whoa, okay.
So I was out one time, and it was like Christmas to 1999 or 2000, and I paddled out, and it was about, let's call it 4 to 6 Hawaiian, which was 8 to 12 foot faces. And it just getting bigger and bigger and bigger. And it got big, so big to the point where I could hear the rocks underwater bouncing off each other. And I'm like, how am I going to get in? I had to take a wave, and I wiped out and I skidded down the face because you're going so fast that it's not like you go underwater. And it's just, you know, these complex systems, you know, from nowhere, just builds this thing up. It reaches a peak, and then there's a phase transition and it crashes. It's like a market, right? It's all this order for slow build up, slow over time. And then something happens where, like, you get these counterintuitive actions where the correlations break down between the input and the result, and then boom, you get this transition or reversal in markets. We call them reversals, and then boom, it all just collapses at the same time. And something that took 6 months to go up is gone in 3 weeks.
Oh yeah, easy. And what you just spoke of there reminds me of this thing called the Cynefin framework. And I think the Cynefin framework is a perfect example of how easy it is for people to assume that something is simple when in fact it might be complicated or complex or even chaotic, you know. And each well, you would be familiar with it. Not many people are familiar with the Cynefin framework, but I mean, when you get into the chaotic quadrant, many people still try to provide best practice solutions when you need to have novel solutions to the whole thing. And when they don't know where they are, it's disorder, you know, and markets operate in disorder a lot of the time, though, because a lot of the times the market doesn't know where it actually is. And that's what makes me laugh when people say everything is priced in. Please explain to me how that could be the case if everything is priced in, because the market would just do that if everything is priced in, wouldn't it? Or have I got that wrong?
Well, like Sora said, it prices in expectations until it gets so far away from reality that it has to change reality.
Yeah.
Right. And it's interesting because a complex system, people think, well, that means you're talking about something complicated. No, it's very simple. If you look at a pendulum, a one-arm pendulum, it's very simple. It just does the same pattern. Add another arm to a pendulum, and it's an infinite amount of paths you can take. Because that simple rules create a complicated mess. Because once something is adapting and evolving, and something's making it do this, and then it's making it do that, it's complicated. In fact, it's funny because my former partner that I managed the portfolio with at Weiss, we happened to meet through Victor Niederhofer. Used to have this speculative list or whatever it was. We met through there, and the first time I met him, he's like, "Hey, what do you think of?" I think it was cocoa or sugar or coffee, one of those softs. I looked and I'm like, "Should I punch it up?" I'm like, "Yeah, they're gonna squeeze it. Everybody's short, and it's just gonna, we just need a catalyst." And I kind of view that as there are a set of known unknowns that you can track, positioning and flows. And then there's the unknown unknowns, which is the catalyst. So if you look back in March 2020 or February 2020, since the beginning of January that year, I was seeing all kinds of things that would tell me to get worried. But that's just the necessary conditions were telling me that to get ready. That wasn't the catalyst. And the market could have gone down at any point, but it waited until expiration in February. And then as soon as that self-reinforcing, long gamma situation from dealers was gone, the market could breathe, and then it started to go. And once it started to go, avalanche. It just fed on itself. And from the distributions shift, right? They go from squeezing tighter in the middle and going up, leptokurtosis, right? High peaks, and then they snap and they go whoom, and they go back and forth from tail to tail. So it's low peaks and wide tails. So this, like I'm saying, the markets, they cycle. Emergent order, high peak, thin tails, tight. And then once you let it breathe, it starts to go, and it's just whoom, whoom, back.
And as you and I have spoken about this before on LinkedIn, the market doesn't follow a Gaussian distribution, even though a lot of things are based on Gaussian distributions. And this is what also fascinates me, is that even if you look at volatility instruments, for those viewers who don't know much about them, though, even an options implied volatility is based on a Gaussian distribution. But since when does volatility follow a Gaussian distribution to begin with? So it's kind of a flawed way of calculating a highly complex and a highly, for lack of a better word, volatile thing.
Yeah, it's a crutch that, look, it's the real world is so weird that you couldn't make up half the stuff that, like, they gave a Nobel Prize to the guys that created modern portfolio theory. I think, what's his name, just died, didn't he, recently?
Markowitz, is it Markowitz?
Markowitz, yeah.
Markowitz, yeah.
Yeah. It's a fantasy land. The real world doesn't work like that.
Like the 60-40 portfolio.
Yeah, well, it simplifies things. It makes you want to predict the past, and I got this efficient frontier, and it's like, well, sure, you just predicted last 2 years, great. But the problem is markets are non-normal. There's skew, there's kurtosis, they're non-ID, they're not stationary, they're non-ergodic. So it's like, you can drive through the rearview mirror for a long period of time. Remember in 2017, the market just kept going straight up. Volatility kept getting compressed and compressed and compressed and compressed.
Until it wasn't.
Yeah, and then I was up in Boston the first or second week of January 2018. I met with a guy who was running a hedge fund. He was funded by CPPIB up in Canada. And he was having a bit of a tough time because he used to work at Convexity Capital in Boston, and their strategy was kind of fixed income RV with a long equity vol overlay, but they never really had that much equity long vol to make up for it. And I said, look, we're in a situation now where the crowding's so bad, we're due for a real problem. And within 4 weeks, it happened. Of course, he disagreed with me, and he didn't make money, and he was out of business the next year because they pulled the funding. But it's like, you have to understand that the market is context specific. It's going to do a certain thing in an environment where the feedback flows are self-reinforcing.
Yeah.
And then it's going to throw off a completely different distribution when they're in an environment or a context where they're self-correcting, right? So you got your high peak thin tail environment where they're self-reinforcing and volatility is being compressed. And then they're self-correcting where you're just you got to unwind quick, right? I need to take this off, and the market goes down, and then the vol and the positioning in the flows lighten up, and then it goes back to the right tail, and then it slipped back to the left tail. And it's like, you have to understand, in the real world, this is how things operate. If you look at a distribution of anything natural, weather, hurricanes, big waves, anything in the natural world that has to do with like astrophysics type stuff where they have billions of years of data. They throw off these distributions that are like that. They're, like weather, high pressure system, sunny skies, light winds, and then boom, low pressure system, high winds, rain, storms. It's the same. They just cycle, right? And it's a very simple cycle that every complex system has. It's an orderly part of the cycle. Then there's a transition into an entropic part of the cycle. It's just the way it is. Look at your life, man. Some days, you're feeling top of the world. Everything you do is right. And then, a month later, everything you do is wrong, right?
Could be in the same day for that matter. And
Exactly.
You wouldn't even see it coming.
But people want to engineer things in the financial markets, and they want to use, it's not engineering. You can't engineer something that's constantly adapting and evolving. And I had a funny story. I don't know if I call it an argument, but let's say a debate.
Discussion,
a
Harvard
professor. He teaches MBA classes, but he's also the head of research at a money management firm in Boston. And I saw something they were doing, and I emailed the head of his partner, the other head of research. I said they were trying to extract probabilities out of from options data using like Breeden-Litzberger or something like that. And I said, well, what you're going to get from this is just a sentiment tool. It wasn't going to do what they thought it was going to do. And so the guy I had sent the email to sent it to his partner, and his partner replied to all instead of replying to his partner. And he said, oh, don't listen to this guy. He's a bullshitter. So I'm like, no. I said, modern portfolio theory. Now that's bullshit. I said, and this is the stuff you're teaching your students. I said, what's going on here is, blah, blah, blah. I go, this is going to be a sentiment tool. It's only going to tell you what already happened. It's not going to tell you, because you're not looking below the surface, right? You're just looking at what these, and they don't even know who bought that option for what reason. Maybe it's some dude that's just plugging something in his book to put it there.
Yeah,
right?
a lot of assumptions are made, aren't they?
You don't know what it is. You don't know just someone bought that deep out of the money put because they think the market's going to crash, or it was something they had to put in the book because it matched up with something else. So it's, you get these guys that, and I find the higher they've gone up in their education, the more, because by definition, if you're going to get a PhD, you have to defend your PhD.
Yeah.
So you generally don't like to be wrong, because what are you going to, you're not going to refute your thesis, right? But then you're not getting your doctorate.
Yeah, Taleb calls a lot of them IYIs, intellectuals yet idiots.
Yeah, Nassim came up with that comment.
Smart guy.
Yeah, well, it's funny because, look, I used to know Victor Niederhofer pretty well, and most generous guy you'll ever meet, super smart, but he didn't believe in, he's like, kurtosis doesn't exist. I'm like, what?
Huh?
And, he blew up twice because he thought, well, you just keep averaging down and martingaling until you come out of it. But the problem is you don't have deep enough pockets. And, he was kind of like the first stat arb guy on the street. He did it for Soros. And then the opposite to that corollary is I worked for John Mulhern, who I don't know if you remember who he was, but
I don't know. I don't remember who he is. Just give us a brief rundown.
Sure. He was initially partners with Izzy Englander on the floor of the MX. And then when the takeover boom started in the 80s, he got dragged into it by Boesky. So he started doing business with Boesky. And when Boesky got arrested, he pointed to John. So John ended up getting indicted for parking securities or some minor whatever. But when I worked for him, he was running one of the big 5 specialist firms, and we ran a volatility book upstairs as a hedge against the franchise floor specialist business. And ultimately, he was in his car one time driving up to Westchester with a trunk full of assault rifles. He was going to kill Boesky. He's in a book called Den of Thieves. If you ever want to pick up that book, it talks all about.
I've heard of Den of Thieves. I'll get it now.
He's a famous guy, but he was kind of crazy. I worked for him about a year and a half, and he was the opposite of Victor Niederhofer. Victor Niederhofer was a very highly statistical guy, used regressions and didn't believe that, well, if it goes down, it'll revert, the law of large numbers, it'll mean revert. John was the opposite. And I think it was 2002 in the fall, the market was getting beat up and our quant came in. He was running a stat arb portfolio and he said, hey, John, we're getting beat up. We should double the risk. And he looked at him, and John was a gut instinct trader from the day one. He said, every geek on the street is telling his boss the same thing you're telling me right now. He goes, take half of it off, and in 2 more days, come to me and we'll start doubling down. Because by then you'll wash out all the idiots. So now here's a guy who understands market dynamics and what's really going on. I don't know if he knew the math of what these quants had to do, because he wasn't that kind of guy, but he understood enough where this was just starting and these guys are going to get slaughtered for a day or 2, maybe 3, and then it'll be time for us to step in. So it's like, having known both type of guys, I can pick stuff from this guy and, okay, this is where he's good at and this is what he's bad at and this guy's good at this. So I've been lucky in my career to have worked with really brilliant people. I mean, my first boss and one of the guys that helped train me, these are guys who went like 10, 20 years without ever having a losing year. I mean,
wow, that's impressive.
Making money. And one of them ended up in one of the Market Wizards books. My former partners in the most recent Market Wizards.
I'm busy with that book now, Market Wizards. Very, very good one.
Yeah, there's 4 books out now, and that's my first 2 books that I started reading. And here's a funny story. I was on Maui in December surfing, and my aunt, when COVID hit, all the rental cars disappeared and they didn't rebuild the fleets. So the rental car prices used to be like $20 a day, and then they end up being like $200 a day. So I called my aunt who lives on Maui. I said, hey, I don't know if I'm going to come this year because, it's ridiculous to rent a car. It's obscene. She goes, oh, no, I have a friend that rents used cars out. She has friends that are only on the island for half the year and they leave their cars and she rents them out. I can get you one. Don't worry about it. Cheap. So I rented this car. So I'm leaving after 2 weeks of surfing, and I'm driving. She's driving me back to the airport. I'm driving. She's in the passenger seat. And she goes, so what do you do for a living? I go, I trade derivatives. She goes, really? She goes, my ex-husband was a commodity trader, a pretty famous one. I go, really? I go, who? And she said, Ed Sakota. And I said, you shitting me?
No way.
Yeah, I'm like, you're kidding.
Sakota of all people.
Yeah, the whole way down the crater, we talked to it was crazy. She was married to Ed Sakota, and she gave me his phone number. I haven't called him, but I don't want to just call him out of the blue. But pretty interesting, crazy for no reason. She just tells me that. I'm like, what are the odds?
Yeah, what are the odds? That is actually one of the best questions, isn't it? Because I've often said to people, and I mean, Mark, there's no way that I can compete with you at your level of complexity and stuff. I mean, I don't operate at that particular level in terms of how I trade markets. But I've often said to people, be very careful when you say something is possible versus probable. There's a huge bloody difference between the two. Anything is possible and nothing is impossible. But it's a question of whether it's probable or improbable.
Exactly. I used to say this to we had this quant developer type guy working for us when I was at Weiss, and he would sometimes say something. I would say, well, look, it's not likely, but there's a probability that if you look out the window onto Park Avenue, you might see a leprechaun riding a unicorn. There's a certain probability of it. It's very low, but it's not beyond the realm of possibility. Right. And I think part of the problem with Wall Street is everybody's really good at statistics, right? Which statistics deals in the past, right? Yeah. Probability, most people are really bad at probability, especially like conditional probability, like Bayesian type stuff, because that deals with the future. It deals with uncertainty and trying to get some philosophical hooks where you can hang things, right?
Yeah, because and we suck at predicting the future anyway. We actually really do.
Yeah, and it's you've got to understand. And to me, to establish those probabilities, you have to understand the context. And what are people doing? Like, what is the positioning? How exposed are people to in this strategy? And the strategies change since I started doing in this business. I mean, there was nobody looking at, I mean, 5 years ago, I started looking at Gamma and Vanna and Charm. Nobody was looking at that stuff 5 years ago. Now everybody's looking at it.
Yeah.
And then there was no risk parity in the 90s, at least not at the level where, money was flying into it. So it's like the people who are moving, the marginal capital allocators have changed. But what's interesting, I don't know if you read this paper, but there's a paper from I think the Swiss Finance Institute called the inelastic markets hypothesis. And what it says in the equity,
but I haven't read that one, no. But I have heard of it.
The gist is, for every dollar that comes into the market to buy or sell, it causes $5 worth of movement. So there's that much skew because everything has gotten so passive related. There's so much passive money coming in.
Yeah.
Over the last, say, 12 to 15 years.
No wonder hedge funds have been getting killed because of that.
Yeah, well, look, the hedge funds are nothing more than like a low beta equity fund now. I mean, charging exorbitant fees. There's a few that do well, but
how many of them still do the whole 2 and 20 model anymore? Because I heard that that's also even falling away now.
Not many. If you want to keep assets, you're not charging 2 and 20. I mean,
yeah, it's like 1 in 10 now if you're lucky. I know some guys who charge 0.5 or 5 even, like if they really are pushing hard for large volumes. But that's more of the exception.
It's crazy because like the money goes to the big funds that are not really hedge funds. I mean, when you say hedge fund, I think like macro fund, right? I think like
Bridgewater
Millennium, those are hedge funds. But like AQR, I don't consider those guys, or Acadian, or even Bridgewater to some extent. I don't really think of those guys as like hedge funds,
Oh, really?
But it's changed a lot. I mean, when I went to Weiss, they had just transitioned from being a family office to becoming a multi-strat. And that was it was a hedge fund then. Now it's trying to be more of an asset manager. They have a mutual fund, and that's kind of the way most funds have tried to go. They want to get more formalized and institutionalized, and it's not the Wild West anymore. It's not like some macro funds. If you look at some of the guys that Rocos and Hadar, there's some guys that still take big risks, but not the equity long short space is pretty much like a 60 to 75 beta now. It's not what it was. I mean, look, for instance, like Balyasny, right? They're kind of like a 65 beta index fund almost. And it's funny because that firm, the guy who started it, Dimitri, he was a day trader at Schoenfeld. Now, the firm he runs is so institutionalized that they would never hire him because he was a guy taking a lot of risk and making a lot of money. That's not their business now. Their business is we want to eke out, enough to keep our fees, keep our assets. It's a bunch of guys with, Ivy League degrees and CFAs. That's who's getting hired there now. That's how it is at a lot of these firms. It's not like when I started in the business in the late 90s, I mean, I was on desks where there were guys that were taking risk. I mean,
gone are the days of the Greg Rebas and all that. Many people wouldn't even know who Greg Reba is, but I mean,
and they wouldn't know who the Borsellino brothers were. I mean, we used to trade. We'd have a squawk box going all day and trade S&P futures back when the multiplier was 500. We'd be trading 100 lots.
Was that high at one point? Holy crap! I didn't realize.
We would trade 100 lots, so we would get ripped off all day, and we'd have to pay the toll in and out, in and out.
50 is big. I mean,
the market it was a half wide, so it'd be like even half. I pay half on 100, and they'd be like, "Oh, you missed it. Now it's half even." So it's like you'd have to pay the toll, you'd pay the boys in the pit, make your bet, and there were guys taking risk. It's a different business now. It's like the holding periods were like much longer. Now it's all nanoseconds. Or I had a guy talk to me the other day. He said, "Yeah, we're medium frequency." I go, "What's that mean?" He goes, "Like we might occasionally have an overnight position." To me, from being in the managed future space, in the CTA space, medium frequency is like 2 weeks to 2 months.
Yeah, more like a swing trade.
Yeah, long term is like 6 months to a year or two. I mean, we had trend strategies in like we trade 2-year bonds, 2-year treasury notes, we might have a trade on for the whole cycle, the whole cutting or raising Fed cycle, right? Because that's just going to go with rates. So it's a different business now.
But I think, just listening to the way you're talking about this, in terms of cycles, in terms of risk and all these things, a lot of these things also apply to training. If you look at it that way, yep. you have to manage your risk whenever you go and lift some weights, or when you go and roll. You're not going to allow someone to crank your elbow all the way out. You're going to tap out.
Yeah,
so
exactly.
it's like
it's a stop loss.
Yeah, it's like a stop loss. So
yep.
so yeah, you can say, okay, I won't tap for anyone. Like there was this fight where Antonio Rodrigo Nogueira, I think he fought against Frank Mir. Yeah, it was Frank Mir. Yeah, and he snapped. And I asked a friend of mine, so why did he allow that to happen? He said, a Brazilian will not tap to an American. And I thought, that's dumb. That's really, really dumb. I don't care who you are.
You got to stop. You got to trigger it. It's the dangerous thing, like I found, is if you go to a new dojo and if you're sparring with a lot of different guys in jiu-jitsu, the guys that are like early 20s and have like a blue belt, they're slow to let go on a tap because they're trying to make a name for themselves. It's kind of like a young pit bull, right? They don't know what they don't know yet, so they're trying to get a thing going.
I tore a guy's ankle by accident. He just wouldn't tap. I was a white belt at that time, still am, but he wouldn't tap for me, and he was a blue belt. I'm like, just tap, dude. No, refused. Tore his ankle, and I didn't even mean to.
Yeah, that's like the equivalent to that. I do CrossFit, and that's the equivalent of, like, I've been doing this on weekends, my kind of day off. I do this because normally I'll do, on a regular CrossFit workout, I'll do a strength exercise and then a conditioning exercise. So there's 2 parts. But on the weekend, I'll do this 30-minute kind of interval training where we call it what is it called? It's what's the term for it? It's
like a HIIT kind of workout.
Yeah, it's high interval training, but what's it called? There's a term for it, but it's like I'll do like 20 box jumps, then I'll do 15 kettlebell swings, then I'll do 10 calories on the assault bike, and then I'll do 5 pull-ups with a 10-pound wall ball between my knees. And I'll try to do at least 6 rounds of that in 30 minutes. So I try to get 5-minute rounds. But you have to know when to stop and let your heart rate slow down a little bit. Because you can't just do that without any stopping, right? You gotta essentially tap out for a couple of minutes, or not a couple of minutes, but at least for a few seconds where you can get your heart rate down. I mean, the goal is to do that workout with a high heart rate, but not maxed heart rate, right? So you do the box jumps, you maybe take 10, 15 seconds, breathe deep into your belly, breathe low, then do the kettlebell swings. And they're not that hard. I mean, that's not that much cardio, but then you're on the assault bike where you're burning cardio again. And then you get off that, you got to take a couple of second break. And then the pull-ups are not really cardio intensive, but there's only 5 of them. So, you've got little spaces where you can get some breather, but it's constantly challenging you to not let it go too far, right? Because if you let it go too far, it's like a stop loss, right? Now you blew it out and you can't continue. Your time's gonna be terrible. You're not gonna get as many rounds as you want. So it's like you have to kind of have this mental thing where am I gonna stop for a couple seconds, take a breather, let the heart rate go from whatever it is, 190 down to 160 or 155, and then you can move to the next exercise where it's more cardio intensive, as opposed to the pull-ups and the kettlebell swings are not that cardio intensive. It's not. Box jumps are, and the assault bike is, because you're moving your arms and your legs. So, it's like that in CrossFit too. Same with surfing. I mean, in surfing, you kind of have to know when to bail, because, depending on where you were surfing, if it's let's say it's a 6-foot wave, the water's 3 feet deep, and below that 3 feet is razor sharp coral. Well, if you're not in the right spot in the wave and you're and it looks like it's going to close out, you got to know when to bail, or you're going to be fish food, So it's like that discipline of saying, okay,
know my limits.
The ego's gone. I'm either gonna, in CrossFit, I'm gonna pass out, or in surfing, I'm gonna hit the reef, or in trading, I'm gonna blow past my stop and I'm gonna lose more money than I expected. It's all trying to create this asymmetry, right? Where you can go as far as you think you can go, and then you got to back off. You gotta take the stop, take the breath, take the dive. Just
no, exactly. I fully agree with you there, my friend. And one of the things you just reminded me of a conversation I had with my other friend Chris Sidiel, who's the co-CIO of Ambrose Group.
Love Chris.
Yeah,
Chris is great.
Yeah, Chris is one of my really, really, really good friends. We actually work together. I'm his performance consultant, among other things. So we were talking about this a while ago, where he also said to me that the one thing you've got to remember is that when you do any form of volatility trading, you have to try and, well, not actually try is the shit word to use here. You have to be uncapped long vol, and you have to be capped short vol, because the thing is, though, you cannot quantify outlying events.
Yep.
No matter how good you are, what regression model or whatever you use, you cannot quantify outlying events. And it's the same kind of principle in trading too, in training too, that most of your workouts are going to be short vol. Just you go through the motions, and you're going to earn your premium in terms of the fitness that you gain and the strength gains that you make. And I call this might be the wrong terminology to use, so just correct me if you have a better way to phrase this, but if you do one of these workouts where you do, say, like your 1 rep maxes, or you do like your maximal rate training, and so that's your uncapped long vol kind of trade that you try and go there for. But if you try and quantify when exactly you're going to be able to do those, or how long you're going to be able to do those, you're really going to bash your head against the wall, because you're not going to be able to.
Yeah, you have to put yourself in a situation where, if you're going to be in a trade that's long, let's even take it back from vol. Let's just look at it from a standpoint of, are you making a bet on a divergence or a convergence, right? So I tend to, because I used to do a lot of work. I started my career in equity derivatives, then I moved over to the macro space and doing trend following and stuff like that. And you want to be long those tails where you're long vol for a situation where something's going to go and go a long way on the right tail. But those only happen like 20% of the time, right? It's like, so the other 80% of the time, you got to find some way to make money. Yeah. So you have to be essentially have some carry or momentum, or some sort of situation on where you're short the tails and long the middle, right? So you got to do spreads if you're gonna try to survive. And so I had a conversation with someone the other day about trading some commodity options, and like, well, what do you think of this market? I said, well, right now the positioning's all neutral. The fundamental supply and demand is kind of neutral. It's a little bit bearish, but the market's kind of holding up. So what would if I was forced to put on a trade, I'd probably sell put spreads and then buy some out of the money calls and delta hedge it on spike ups, because I don't think it's going to really start going, because there's not a lot of agents coming in and feeding back on it. It's kind of random right now. So I want to make money off that put spread, because I don't think it's going down much. If it does, it'll bounce back up. But I don't think it's going up a lot, but I think the jumps will be to the upside. So I want to have that call optionality, because in commodities, things tend to be positively skewed because they're not fungible, right? So a shortage will show up quickly in the forward curve, but it also show up in the skew. So I'm like, well, I would own some, like 30 delta calls, and I would sell some, out of the money put spreads. And then if it spikes up, then I'd lock in my deltas, because I don't think it's going to keep going. I think you're going to get a bounce, come back, bounce up, come back. And then once it does start to feed on itself, where I start to see the momentum players come in and the curves start to get flat to backwardated, then now maybe I'd want to be just long deltas. But, that's kind of like what you're talking about. You have an upside long optionality, but to pay for that, I'm going to sell some put spread where it's going to cut down on a half or 2/3 of the cost for me to own the call, and then I'm going to trade the deltas because I don't think it's going to be one of these, slow grind up. I think it's going to jump, but the jumps will be on the right side of distribution. So I want to, lock in deltas on that. So yeah, Chris is a sharp guy. Look,
oh yeah, super sharp guy.
Considering his background, he's a street smart guy that learned the quant stuff, right? Those are generally the best guys I knew on Wall Street. I mean, I know guys that are really profitable and they're not that quanty, right? They were just really great gut instinct trades. They understood, let's call it subconsciously, probabilities, right? They just could. The first guy I ever worked for in New York, he was the best knife catcher I ever met. He had been a lawyer at Skadden Arps, top of the food chain, hated it. So he left, he went into risk arbitrage, and then he kind of got bored with that. So he's running his own money, and then he ended up coming onto the desk at Spear. He was a clearing customer. And we would sit there and, some news would come out on a pharmaceutical stock and it would get beat up, like down 10, 20%. So we'd do some work. We'd call up doctors, we'd call up and get what's the real story here. So we know the story. So we got the story. We know what's going on. Now it's about, let's check the market dynamics. So we would put a little position on and then see if it worked. And if it didn't work, then we'd say, okay, let's find out where the real buyers are. So we would sell like 100,000 shares at the market. And this was back when there was a specialist system. And you dump 100,000 shares on the market, you're going to find out where the real buyers are, especially in a situation where there was just bad news a couple of days ago. The market's illiquid. Nobody wants to touch it. It's not like it is now where it's, all computers running around. And this was back when guys would take big positions and he would find the bottom and stuff. And he would, but it was a process. You had to go out there, just drop it and see where it landed. And if anybody would come in and prop it up, and you could ultimately find the liquidity. And that's okay. We kind of have an idea now. Now then it was a question of where are the real buyers going to come in to get it to go up? It's one thing to find the bottom.
Yeah,
it's
then
another
you
thing,
step in.
Yeah. And then, I really learned probably the best risk management lesson of my life from this guy. I was quantitative. I wanted to be a physics major in college, but I decided not to. I went and studied entrepreneurship and some finance and economics. And I thought, oh, well, I understand value at risk. I understand statistics and three standard deviations, all this crap. And he had been a risk arbitrator. So what happened was there was a deal between SmithKline Beecham and Glaxo in 1998, I think it was.
Yeah, it was 98 to 99. They merged, if I remember correctly.
On the second try they merged, but the first try it failed.
Yeah.
What happened was
I was a kid back then.
He said, what we're going to do is we're going to short Glaxo. And he had a legal reason, but he also didn't think the CEOs could share power. So it was in the fall sometime. And this was back right when cell phones were just starting to become popular. Like nobody had them. So one day we had to trade on for about 5 or 6 weeks. And we had lost a little bit of money because those spreads, they kind of slowly grind tighter as they go towards the closing date, or clear and Hart-Scott in parlance. And boom, one day after the close, a red headline comes across his screen and he's already in the car going back to Connecticut. And I dial him up. I go, Andy boy, we got him. Deal's in jeopardy. And what the whole thing was, essentially a risk arb spread is you're selling a strangle, right? You're selling the target, the acquirer, right? You're selling SmithKline, you're buying Glaxo. And if something goes wrong, you know exactly what everybody has to do. They have to sell Glaxo and buy SmithKline. So it's path dependent. So when that happened, and this was a big trade, and he tried to explain to me like a few months earlier about how you're never going to make the big trade in this business if you're just buying the trends and things. And this was quantified. I'm like, oh, I get it now. This is how this game works. I know if a catalyst goes off, these guys have to sell and these guys have to buy. So from that point on in my career, I went around and looked everywhere. I'm like, what else happens with this? I'm like, in the option space, I'm like, oh, if there's a big open interest below the market, let's say the market's at 100 and there's a massive amount of calls at 95. If that thing trades below 97.5, I know what's going to happen because somebody's a dealer on the other side of one of those trades. They have to synthetically replicate that option. It's going to be a vacuum. It's going to hit a hole. Then I started looking at systematic trend following. I'm like, what are these guys? They just buy because something goes up and then it goes up and they buy more. I'm like, okay, I can put these guys. So now I can understand what everybody's doing and why. And it's all very simple cause effect stuff because they're all kind of Cartesian in their logic. So I spent my whole career just finding, and there are always new ones coming in. Like this most recent one is this dealer gamma Vanna charm stuff, right? That's what everybody's looking at now. It's just a feedback mechanism. So it's like, I learned so much about risk management in the real world from that one experience with working for this guy. And he was probably one of the best traders I ever met. And I met some really talented people. I mean, like the other guy that helped train me, kind of a mentor of mine, he ran a hedge fund in a room with himself and two other guys. He ran $1 billion hedge fund.
Wow.
I think he went 20 years without losing money. I don't know what he's doing these days, but
that's incredible.
He was a really good options trader. And the funny story is, if you read his story in I won't embarrass him by saying his name, but if you read one of the Market Wizards books, he'll talk about it. He says it in his interview. He said, yeah, I blew up like 3 times when I went to Chicago, and I had to really have a conversation with myself. Do I really want to do this?
I know who it is.
And then, do I want to do this? Because if I'm going to do this, I really have to stop this self-destructive behavior. And he used to call me up, like, if I had a bad day, he goes, remember one thing about this business. He goes, you getting fired today? Tomorrow you might be the head of the desk, because that's how this business is. It's crazy.
Oh, yeah.
And he went from being a guy who understood that this whole business is about risk management. The rest is all like conversation. It's bows on the top of boxes.
Couldn't agree more with you. Couldn't agree more. We are not risk takers. We are risk managers. That's what it really boils down to.
Yeah. You could randomly pick 10 stocks, just buy them. And then you have stop losses, and there's a chance you could make money with that portfolio if you just cut the losers at a certain, you have a stop, I'm out. The other ones, you let them run. You could theoretically make money doing that. I mean, I wouldn't do it as a strategy, but it can't be any worse than predicting the past like most people are doing now. I mean, they're just optimizing to what already happened. And it's really bad now with ML and AI, because now it's finding all these nonlinear relationships that have happened, and it's not telling you what they are. And it's just saying, if we're on this road and the road doesn't have any turns, just keep hitting the gas.
Mark, I'm of the opinion, and I could be very wrong, but one of the next big meltdowns, I don't know when it's going to come, because if I did, I would be short of that thing well ahead of time.
Sure.
Trust me on that. But I think one of the next big meltdowns is going to be caused by AI. Some kind of a malfunction or some kind of avalanche type event where it's just going to trigger. And because one of the things that I teach in my course is the importance of context plus content, not just one or the other. And I find that we actually live in a world, if I look at social media, LinkedIn, for example, and Twitter, those are the 2 ones that I use. Geez, people barely have a concept of context, but they're so content driven. It's actually quite scary to me at times. Even in markets, you see a news piece come out, and I look at that and I think, okay, let's use today, like, for example, the whole credit rating drop. What's the word I'm looking for here now? My mind just got blank. Downgrade's the word I was looking for. I mean, at the end of the day, from going from AAA to AA+ is not the end of the world.
It's meaningless.
It's meaningless. As a friend of mine also said, Beat Nussbaum, I would actually like to introduce you to him, though. He's one of the best macro FX traders I know. And this guy's just awesome. He's been trading for as long as I've been alive. And he said to me, look, Adrian, it creates a brilliant bad headline for markets to respond to and for news outlets to sell. He says, but at the end of the day, if you step back even 1 step or 30,000 feet, he said, so fucking what? Those were his exact words. And I thought, so true.
Yeah. And I try to tell people, I say, look, if that news comes out in any other point where people aren't so short vol and crowded, it's not going to matter. It's like, there's a difference between lighting a match in a room that's full of dry leaves that you poured gasoline on, and one where there's a pile of wet leaves with water on them. The context, like you're saying, the context is the most important, yet nobody looks at it. It's like, my father died of colon cancer, and I tried to explain to him and the doctor at the time the stuff that the food they were giving him, like from the nutritionist while he was on it, it was all like this carbohydrate and high sugar stuff, and I'm like, wouldn't the goal to make your body more alkaline instead of more acidic, so you're not increasing, the tumor growth? Wouldn't you want to just be eating like just meat, essentially, to try to get your body to function, as optimally as possible? And like the doctor was like, oh, maybe. And, my father wasn't gonna do anything I told him anyway, but, which is kind of like why I'm the way I am. I mean, someone tells me it's raining out, I'm not gonna believe them until I go out there and put my hand on and get wet. Yeah. That's just me. I doubt everything, right? But, that's just the reality of it. It's the context is everything. And if your system is operating on a neutral pH balance, and you're not shoving poison into it, then it's less likely that something that comes into it is going to affect it. But if you're all messed up, if you're fat, you're overweight, you're eating, takeout food at McDonald's, you're whiffing down 32-ounce sodas, that's like a half cup of sugar. And then, COVID comes along, well, you might die because your comorbidities were off the charts, right? Whereas,
Oh yeah.
I had COVID twice. Once it lasted 3 days, and the second time it was violent for about an hour. I mean, I literally started shivering and couldn't stop. So I wrapped myself in blankets, and I got to the point where my heart was slowing down, and then I kind of passed out. I woke up and it was all gone. It was like a 1-day situation. But I do a lot of training. I work out a lot. I eat.
You do all the right stuff.
Yeah, so my initial condition, my context is neutral, right? So it's ready to fight. My immune system is ready to go. I mean, I'm not avoiding, going outside in the woods or whatever, But that's the one thing with people, they really overlook context. Everything is content, like you said. It's all about, what's the chart look like? What's the news? What are the earnings going to be?
What's the new TikTok video?
It's like the markets are a Keynesian beauty contest. It's not about who the prettiest girl is. It's who everybody else thinks the prettiest girl is.
Exactly that.
And if you can't know, if you know what the crowd's doing and where they've gone and how big the crowd is, then you're not surprised when things happen like today or 2020, because it had to happen, right? The markets are not going to, unless the central banks manipulate like they did for many years, where they kind of drove assets out the risk spectrum, and they kind of subsidized beta at the expense of alpha in a wealth effect, right? They wanted real estate prices up. They wanted the stock market up. That kind of drove up credit markets. That was kind of structurally manipulated by them, right? And it came to a head in 2017, right? When the ball just went to nothing.
Oh, I remember that.
And now people still don't understand that we've made this change where the central banks are no longer the people you need to follow. It's the fiscal authorities. I mean, look what's going on. If you look in the US, there's a lot of money being put into manufacturing in the economy because everything's going from globalization to regionalization.
Yeah, localization now again, yeah.
Look at the strongest currency over the last year. It's been like the Mexican peso. The best carry traded was dollar Mexican and Mexican yen, right? Now, I wouldn't buy those today, but these things are all being done because we're coming back in, we're kind of reshoring, and it's going to be fiscal policy that's going to be dominant for the next, say, 5 to 10, maybe more. The whole, if you're just watching central banks, you're just focused on the wrong thing, man. You're looking east for a sunset. It's just, the game's changed.
I like that one, looking east for a sunset. That's a brilliant one. I'm going to remember that one.
The game's changed, man.
But that's what Chris said to me too. Chris also said, whenever you see these people saying, I tracked the data for the last 30 years or whatever it is, he said, why? The market has changed over the market changes probably every 4 or 5 years or so. He said it's pointless to go and look back at 30, 40 years worth of data, because people say, oh, well, if we look at climate data, yeah, then you can look at 100,000 years or a billion years worth of data, but not in markets, because the dynamic, it's a dynamic organism, not a static one. You cannot apply static means to a dynamic organism. It's just impossible. You know?
Well, you can't, but they do it. And they do it, and that's who they continuously bring more people in, because they think. I had a conversation with this guy. I won't name the fund, but it was a firm in Boston, and they were like, well, we're trying to find someone that can help us better optimize. I'm like, well, it's an existential problem, and you're existentially wrong trying to solve it that way. I said, I gotta shut the door because now he's gonna bark.
Oh, yeah, sure, go for it.
So I said, look, if you want to optimize, if you have a portfolio, this is what we did at Weiss, my former partner and I. We had two strategies, essentially. One was optimized for a fin tail high peak environment, and the other was optimized for a low peak fat tail environment. And we ran them concurrently, and one took half as much risk as the other. So essentially one was long vol, not really, but because we were using futures, but it kind of replicated an option. The other was short vol because it kind of bet on trends, and trends vol kind of dissipates as they go, because like information theory, as signal becomes more cognizant and more input, information goes up and entropy goes down, right? And then it creates a pattern which goes further and further and further until it's pure signal and almost no entropy. Then you do for a bust. And then it goes the other way where it becomes less signal. So we had these two strategies that one would work in one environment, one work in the other. And that's the only way you can do it. You can't optimize for what already happened, because then as soon as it changes, you're screwed. So you've got to kind of be like, and Chris kind of, I think he tries to sell this because that's what his fund is doing.
Yeah.
He's trying to go out to RIAs and wealth managers and say, look, you have a long stock bond portfolio, whatever your portfolio is, it's consensus strategies. Well, we're a tail hedge. So in fact, my friend, what's his name? Hari Krishnan, he runs the tail hedge fund too.
Oh, yeah,
Hari has a PhD in chaos theory, so he understands this stuff.
That's tough stuff.
So, but he understands it. But if I try to talk to someone who has like a hard physics PhD, I try to explain it to them, they're like, no, we should be able to optimize this. I'm like, you can't optimize a moving target.
Mm-hmm.
Because as soon as you do, it changes.
Yeah, you would have seen this in MMA or jiu-jitsu, wherever. I mean, like I like to use this very simplified analogy where I say some days you are the guy delivering the haymaker, and you could also be the one who receives the haymaker, you know. And it can happen like that. You could
happen the other night. You Dustin Poirier.
Yeah, you could go up against someone who is weaker than yourself, smaller than yourself, but they just get that tiniest bit of a gap. When you dropped your hands or you weren't looking or whatever, next thing you know, boom, on the button, on the jaw, wherever, you can leave with a bloody nose, a knocked out tooth, and it can happen to any of us. Doesn't matter who you are.
That's your out of the money option, right?
Yeah.
That's your long. Most of the other stuff, it's short ball because you're just trying to, trying to distract until that opening comes up. And it happened. It was perfect the other night with Justin Gaethje in that Poirier fight. Justin just didn't see that foot coming around and caught him in the back of the head. That was it.
Ka-dunk.
That's all it takes. And same with the markets. I mean, look, I was talking to a guy who runs a pension fund. He runs like a derivatives overlay for a big pension fund. And he systematically owns out of the money options. They kind of delta hedge around those. And in 2020, VIX went to like 80, and he had uncapped variance, and then ka-ching, that's going to pay for about 5 years worth of,
if not more
problems. Yeah. And it's, but you've got to have some sort of short vol methodology to pay for that every day that's going. And if you can understand where you are, and look, if you look at a guy like Bill Gross at PIMCO, he had a great track record, but most of it was him selling strangles around his position. He wouldn't do it when he thought the market was going to move a lot, but he was pretty big vol seller, and that adds a lot over the years.
one thing I've noticed too about quite a few guys in the markets, I mean, you get some real gems who are crazy smart people or incredible risk managers and incredible, dare I say, risk takers, like Paul Tudor Jones. Paul Tudor Jones is a pretty top-notch trader. I mean, if you look at
brilliant
how
risk manager,
if you look at how he managed that crash of 1987, I think that's where he really started to make it big, was in 1987. Ray Dalio also did very, very well for himself. I mean, Bridgewater didn't become the fund that it is for no reason whatsoever. Though the one thing I will say about Ray is that Ray actually saved me money on a few occasions when he went on on national TV and made a few statements, and I did the opposite of what he did. So I'm not calling him a contraindicator by any means. However, I did remember his own weakness that he acknowledged, and that is whenever he makes very public statements, he has been wrong in the past, and it cost him dearly. So I kind of did the opposite. Sorry, go ahead.
That usually happens to everybody. I mean, look, if you're a firm who puts your name on your building, happened to Solomon, happened to Bear Stearns, there's something about reality that doesn't like hubris.
No, no.
If you're, I know a guy, my first boss, one of his friends was a pretty well-known risk arbitrager. He ran risk arb for SAC, and then he ran for Soros. And when he was interviewing with Soros, he said, when you talk to this guy, you would think he never had a winning day, because it was always complaints and miserable. And you wasn't like, he was walking around, he was making a lot of money and he was like up on everything. It was always, where could I be wrong? Where's the risk here? He said it was weird because, for a guy that was so rich and so powerful, everything was just, it was constant, worry and complaints. It wasn't euphoria where, we're doing so well, it's just,
no,
that's
the best guys don't really advertise. And I've seen this in trading, I've seen this in investing, in fighting it's always the ones who are trying to make a name for themselves, or actually that we're all trying to make a name for ourselves in some way. So that's actually the wrong way of putting it. It's more a case of the guys who want to show off. That's the terminology I would use here. They're the ones who want to show off, who advertise the most. But the best guys that I've ever rolled with or boxed with, they're chill, they're calm, they know they can rip you apart with their bare hands if they want to, but they don't. They're also of the most, not modest, but humble guys, like genuine humility, not that fake pseudo humility, but the genuine kind. And that's what makes them such interesting, attractive people.
Yeah, well, because look, nobody likes a show off.
Not even show offs.
It's just not. It's not a good look. I mean, and the worst thing that can happen to you is you do it in an environment where you happen to have been lucky and it wasn't because this business is weird. It's not like most businesses where in a lot of in businesses, the skill to luck ratio is not as even. In this business, you can get really successful by being lucky, right? In most businesses or in a sport, you got to be skilled, right?
Yeah.
I mean, I've worked for people, with people, not so much but with, where they were extremely skilled people, but there were other guys doing much better because they misunderstood the risks and were willing to take dumb risks. And the markets went up and they just were levered, and they made a lot of money. And it was like, and then when they did lose money and get thrown out, well, they already had their money, right? Because it's a weird, that's Wall Street's changed a lot, because it used to be about maximizing your optionality for your bonus. And when is an option worth the most, right? When the vol is the highest.
Yeah.
So if you go work for Citibank, maybe you're going to get 10% of your P&L as a bonus. You take as much risk as possible. And if you lose 100 million, well, you go to the next bank. Remember when Amaranth blew up? That guy was funded within 6 months. He had his own fund going again. The guy that blew up in Nat Gas.
Yeah, it's quite amazing how they get more money.
Well, if you lose 5 to 10 million, you're never getting a job again. If you lose 50 to 100 million, now you're famous.
How in the hell do you explain that? You know,
it's a perverse but interesting situation that happens over and over and over. It's strange, but like
it's like the guy from WeWork. Do you remember the guy who crashed WeWork? And essentially he's been offered like $1 billion or something again to start the next thing, and he was. I just looked at that and I thought, how do these guys do that?
I didn't meet Victor Niederhofer until after he had blown up the second time. And the same guys that gave him money the first time gave him money the second time. And I'm pretty sure they were European family office money. I'm pretty sure they would have given him money again, because it's a very strange. There's a whole nother conversation about allocators. It's a weird business. It's not about putting money where the best risks are. It's about putting money where everybody else is putting money, and pretty much hedging your career, not your portfolio. It's a weird.
Do you think there's a bit of an ego element in the allocation game too? Like, oh
yeah, it's strange. I mean, I've met some of these guys. Actually, I thought about actually going to that side of the business and working as an allocator at some firms, and like they don't want to hear what I have to say.
I didn't think they would.
Because look, they're comfortable with where they are, and they're not looking to see. They don't want an optionality in their payout. They want to have a pretty good idea of what they're getting paid. And sure, if everybody loses money because I have money in this strategy and that whole sector loses money, that's fine, because I'm not going to get fired. I understand that. But because the business has changed so much, and a lot of it has to do with what's your back office, who's your lawyer, who's your clearing firm, who's your prime broker. I mean, that plays a much bigger role than performance does now. And the bigger you are, the more money you attract. It's a different business. It really is. It's not like if you're a guy, if you come out of Goldman, look, for perfect example, you had those guys that came out of Goldman that were brokers. They walked with at least $1 billion, and then they blew up that Canadian pension fund. And then I
think it's this whole credibility thing too, that if you worked for Goldman or JP Morgan or whatever, you must be good. But you and I both know that's not necessarily the case. You might have been lucky. You might have gone to the right university. I swear, I actually read this in some, I think it was the Guardian or the Financial Times, whichever it was, where they spoke of this fraternity. I think it's at Yale. I think it's Yale or Harvard, one of the two, where they say that if you went to that specific sorority or fraternity and you used a handshake and went to Goldman, you would have a 90% chance of getting a job just by using. No, I cannot prove it, but that's what they said. You drastically improve your chances.
That's who they hire. I mean, look, generally speaking, the firms want. The new thing is now they want someone with a master in financial engineering, a CFA, or a PhD in a CFA. And for what reason, I have an idea. Most of the stuff they teach you in those programs are what not to do.
CFA, why?
But that's kind of the ticket they want you to have to join, because most of these firms use it for marketing purposes. We have, our whole investment research staff has a master's in a CFA. All right, it's marketing. It's kind of like you hire a PhD in the risk department, so if a firm blows up, you can blame him, right? It used to be a Russian guy, but now it's become more an Indian or a Chinese guy.
Yeah.
So that's when I was at Weiss, we had a Chinese guy who was a PhD. He would, if the firm didn't take a lot of risk, so we didn't have to worry about it. But that's generally what happens. And then they're not. Only recently do you see the risk department's kind of looking at portfolio construction and realizing that everybody's using the same stuff. They're all using factors. They're all using X, Y, Z, some sort of risk parity of all control or whatever. So now they have to kind of think about looking at that. And actually, Point 72, who's they kind of started their career.
Stevie Cohen.
Yeah, his whole business started with understanding flows and buying at the end of flows that were negative, and he always would get the first call, so he'd buy that print. But now they're kind of actually building out a group where they're going to follow flows and help the portfolio managers understand context. They're really the first ones I've met that are doing that. I tried to sell that to a couple of other firms that I talked to over the last couple of years. They really didn't want anything to do with it. They're still stuck in the VAR and whatever kind of other.
You posted something, you posted something very interesting about VAR a while ago. It was about a year or two ago, where I cannot remember exactly what you said, but you had a nice long piece on LinkedIn about VAR not being as great or as useful as what many managers make it out to be, because that's one of the first things that they often teach you at any of these finance courses about, value at risk and blah, 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 blah. But I read that and I thought, well, fuck, thanks a lot for Mark being here to actually point out that this stuff sounds great in theory, but in practice, it's like what Taleb points out, what who was the guy, Yogi Berra, always said, in theory, there's no difference between theory and practice. And in practice there is, and this is a prime example thereof. Yeah, and it's Nassim. He has that real world risk management course, but I think people misunderstand who really. Nassim's smart and he's a very good promoter, but the two other guys that are involved is a guy named Robert Frey, who is a super brilliant guy. He sold his firm to Renaissance Rentec. He worked there for a while and then retired. And then Rafael Duade, who's a professor at La Sorbonne, who I talked to a little bit. And in fact, I put a post up once and I didn't realize, but he had written a paper about this. I was talking about Sharpe ratios, how in the limits, they're contrarian indicators. In the middle of the distribution, they're fine because it's not, but generally speaking, what happens is the highest Sharpe ratio of last year is going to be the worst going forward. In fact, Raphael's study said, if you took the top decile Sharpe ratios, he said they tend to have really bad forward 1 and 3 year forward results, because from an information theory standpoint, the signal's already there, right? You've already, it's this much information, this much signal, and this much information and this much entropy, right? So a high Sharpe ratio is more likely to have negative forward returns because people have seen it, invested in it, and other people noticed it and acted on it. So what they've done is they compressed the vol to generate that return. And going forward in a complex system, you don't want to have a 99% information, 1% entropy. That's kind of not where you want to invest. You want to do the opposite, right? You want to own the 1% and say, I don't want to be part of the 99%. Now, it's a little more difficult when you're talking about high frequency strategies. So I tend to say anybody that holds a position for like more than 3 days, right? Because you can have a 50 Sharpe if you're like a high frequency nanosecond trader. That's different. That's more, the Sharpe ratio has become more about a holding period signal these days. Yeah. If you tell me your Sharpe's 15, well, I'm telling you're not having a holding period more than like 30 seconds. I had a Sharpe ratio of 7 at one point. So what? I tell you, it actually means very little. Yeah. I realized that. I learned that the hard way. It means next to nothing.
If you look at a firm like TransTrend, Harold over at TransTrend is one of the more brilliant trend followers, because he's not. He's a real world mathematician who grew up on a farm. He's not a guy who came out of RPI or MIT or Caltech and said, oh, we're just going to look at the statistics. Their Sharpe ratio is like 0.7, and they have an 11% annualized return net of fees over like 30 years.
Well, there you go.
Pretty good. And it's a 0.7 Sharpe ratio because they understand as a trend follower, you're capturing that emergent order. You're just giving up those drawdowns because when you hit the entropy cycle, their reactive strategy is not predictive, right? They only buy after stuff starts going up, and then they only sell after it starts going down. So there's always going to be, a level of volatility that's going to be higher, which to me is like, who cares? I'd rather, what is my long-term compounded return and what is my maximum drawdown? the volatility thing is to me is so puzzling that this is like the go-to risk model when it's self-referential, because almost every strategy out there is using it as an input and a target, right? Value at risk, vol control, you name it, Sharpe ratios. You're always trying to optimize for that lower vol for that amount of return. The problem is once you start altering any natural system, you're going to create latent risk. And nobody looks at latent risk because it's contextual, right? They only look at residual risk.
Yeah.
And that's content driven, right?
Mm-hmm.
So to me, it's like, all right, well, you want to run these, and all these mutual funds have these strategies. They're vol control programs. They say, well, we have a 10% vol control. So if realized vol, if I look at 20-day, 10-day, 20-day, what is it? No, 1 month, 2 months. So 20-40, realized vol, when realized goes above my target, I have to take risk off. And when it goes below my target, I got to add risk. And then I have like a 1.5% max threshold of leverage. I track these guys. A monkey can do it. So I just sit there and watch. And I'm like, all right, these guys are up to 100% risk again. You know, they were in January 2020, they were at 1.5. They were maxed out for like a year. They were just fully invested. And it's like, okay, everybody's already made that bet. You know, when I started in the business, guys taught me, you know, I would see a headline and like, oh, should I buy this? And like, well, who do you think? Do you think everybody's already made that bet or not? And if
they've probably seen it before you have,
then the news should, the price of the stock should either go sideways or down on positive news if it's already been priced in, right? It's kind of like the game we used to play in the early 2000s around earnings. Like, okay, we'll buy it into earnings. And then as soon as the earnings came out, if it was good, they would spike it up and that would be the end of it. If you didn't sell on that spike.
Yeah, exit liquidity, you know.
It was over. And then you'd toast if you're a trader and traded the calendar, you know? So it was, I came up in the trading environment where I learned about real world risk, context, latent risk. And then as the quantitative systems got more and more assets under management, it's made the game somewhat easier, but it's more binary, right? Where you go from just going straight up and quiet to just woof.
Yeah, but mate, you know what? I've been talking, you know, to a few people about this, you know, including my brother, you know, people like Chris to some extent. I mean, you know, because I really value his opinion, and a few other friends of mine too, who are also in the trading game and in other fields. But if you look at politics at the moment, how polarized politics has become, you know, it's actually freaking ridiculous that in a country like America, and I'm very pro-American myself, you know, because I think that, you know, America offers a lot more good stuff than bad stuff, quite frankly. You know, people wouldn't move there if it was such a shit country. Let's also be honest, you know. So that's one way that I look at it too. But the other thing is, it's a democracy. It's meant to have people who have different views. You know, if you have freedom of speech, people are going to have different opinions and things. But nowadays, it's a case of if you're Republican, you're bad. If you're Democrat, you're good. Or if you're conservative, you are archaic. And if you are a liberal, you're progressive. And people, you know that progressiveness is not always in the right direction. You can progress in the wrong freaking direction very quickly. You know, some traditions are wonderful to keep and other traditions should be let go of. What is so difficult to understand about this? And the same with markets, the same with training, the same with trading. You know, it's like, sorry, go ahead.
The world has become bifurcated, and I think by design. I think the people who control what you see and hear want it that way. I think they want
suits them
there to be this. They want for some. I'm not sure exactly. Well, I can guess why they want this to. I see where they want it to go. They want some sort of like major clash ultimately, so they manufacture this chaos between two opposing. It's a Hegelian dialectic, right?
Yeah, it's very dissensual.
You have these opposing forces, and they want more and more and more opposing force that at some point will become, you know, you have thesis, antithesis will become some new thing. That's kind of dangerous, because the reason the founding fathers in the US understood that would happen. So they kind of created a system where that shouldn't happen, but it kind of is getting whittled away. And we allowed a couple of things happen in this country that never should happen. One, we should have let corporations have the same rights as individuals, because they're not. A corporation is a psychopath. It only cares about profits. It's not ethical or unethical. It's not moral. It's not amoral. It's not moral or immoral. It's amoral. It doesn't even consider it.
Yeah, but Mark, it's exactly that. And you know, to build onto your point of what you just said, it's like capital. I've often said that capital has one allegiance and only one: to flow to the places where it can get the highest yield at the lowest risk. That's what it really wants above all else. It doesn't care about your feelings, your sentiments, your beliefs, nothing. That's what it wants. And it's the same with the corporation. It wants to make a profit.
Yeah, but the problem lies in, once you've given the corporations the rights as individuals, you gave them the right to funnel money into the democratic process, which allowed them to, at this level now, I don't think people even understand how a law becomes a law in this country. Back in the day, there were Congress people writing bills and voting on them. It's all written by think tanks and lobbyists now.
Yeah.
So if you're a company, let's say you're Goldman Sachs and you want to violate a law, well, you have two choices. You can either do some sketchy shit with CDOs and make 10 billion and pay a $1 billion fine at the end, and not either admit nor not deny guilt, or you can just go to your lobbyists and change the law and say, we don't like this law. So you go and change it. So the problems become, certain groups have become so powerful and that they're shaping the laws. And if you've seen what the result has been, you've had this wealth disparity. I mean, really, you've seen massive economic progress in technology for like gadgets, right? For this, right? For phone, for a computer. So. But if you think about it, we haven't put a man on the moon since what? The
1972.
Late 60s, early 70s?
Yeah, 72.
Where's the progress in science outside of technology? I mean, do we really need faster gadgets?
No.
I mean, is that all there is? I mean, what about clean nuclear? I mean, this big thing about, we're going to force, net zero down everybody's throat. Sure, you can try, but we're not ready for it. So that's just going to make higher prices, because civilization rests on 4 pillars. It's steel, concrete, plastic, and ammonia, right?
Guess what? They all produce carbon.
They all take massive amounts of fossil fuels. You don't exist without those 4 pillars.
Even EVs are not green, and I've told a few people this, and they're like, oh, "How can you say that? It doesn't release any emissions." I'm like, "Do you realize how many emissions are released in the manufacturing process?" Yeah, I saw this stat, and maybe you have a better figure on this, but I seem to recall that if you own a Tesla, everyone's into the whole freaking Tesla thing nowadays, that, oh, it's so green and all that, but you have to drive something like, I kid you not, 100,000 miles before you break even on the carbon footprint that it costs to produce it in the first place. Something like, it's 100,000 kilometers or miles. It's one of the two. Either way, it's a lot.
Yeah. And where do they think the electricity comes from?
Hydrocarbons.
Natural gas and coal.
Yeah, exactly.
So it's like, but to me, it's like, what happened in the country back 40 years? We went on this path of globalism, and we kind of subsidized personal technology and technology in general at the expense of all other science. I mean, think about it. We're still driving, 4-wheel cars. We're not in jetpacks. I mean, how come science hasn't progressed in any other area but gadgetry?
Yeah.
I mean, essentially,
bread and circuses. To me, it's a form of bread and circuses that has taken place, though, because Carl Sagan, I'm a big fan of, huge fan of Sagan's work. And You know, my friend Beat and I were actually talking about this earlier today when I posted something on his LinkedIn, because he said that if you look at the latest stats, though, is that fires, NASA's data has actually shown that the wildfires across the world have actually gone down a lot, but news reports of wildfires have actually gone up 400%, you know, over the last while. And he said that if you look at that, though, it just shows you why people are scared of all these things, you know, and wildfires is not the only thing, but it's also the whole climate debate. I'm not saying I don't want to live in a cleaner world. You want to live in a cleaner world. I want to live in a cleaner world. Who doesn't?
Of course, who doesn't?
Anyone in their right mind wants that. But but it's like what Rob Schiller said in his book called Narrative Economics. Narratives sell better than facts. And I've tried to explain that concept multiple times over. But the problem is, Mark, and I think you might agree with me on this, more people are interested in emotive reasoning than what they are in logical reasoning. Because emotive reasoning feels good. It drives your passion or whatever. I hear the words, well, I feel so strongly about this, or I feel passionately about this. Sure, but are you accurate in what you are passionate about? You know?
It's funny because a former client of mine, when I had my CTA, he was a friend of mine that I grew up with, and he got into, his father he manufactured pens, and he was doing it in China. And so this guy understood how to get stuff done in China. He was over there quite a bit. He got into trophy business right before the whole participation trophy boom. Oh, and gosh, he didn't do that intentionally. It just, he got lucky. And he had like 2 or 3 big clients, and he did quite well in it. And what happened was they started teaching people that their emotions were mattered to an extent where we should manage the world around how you feel, not how you think logically. And now we have a generation of people who, unfortunately, can't function in the real world when they're overwhelmed with multiple things coming at them. They don't handle a complex system very well. I was on the other day, it's not the first time it's happened. I was going onto a highway, and this millennial girl in front of me, I could tell she was in her like mid-20s. She's about to merge onto the highway, and she panicked and stopped because it was all too much for her. She couldn't figure out how to merge, how to anticipate the person going in front of them and then come in between cars. So and I've seen this a few times. And I've noticed also the traffic patterns now. What happens is people are going, and if they see someone on their right lane hit the brakes, they hit their brakes, not the person in front of them. And they're creating this unnecessary traffic because they can't function when more than one thing's coming at them, because it makes them nervous. And now all of a sudden the feelings override every bit of logic, right? Oh, yeah. And it's like, I just have to stop because I can't handle this. And these are the same people who are either hopped up on SSRIs or Adderall because they can't focus for like more than 10 seconds. And it's like, what are we doing here? What are we doing to people? We're telling them to be emotional. We're telling them to manage those emotions with pharmaceuticals because they're on TV and they're telling you they need them. And every day there's a new symptom. Look, it's a complex system. Anything that you look at and focus on, you're gonna alter, right? So if you start thinking you have a problem, you're gonna manifest a problem. The human body is the ultimate complex system. You start telling it you're feeling good, you know, you're gonna feel a little better. But you can feel like the sun should rise in the west all you want. It's not gonna happen. And it's the world is, and I talk to people, like I talked to a girl today, and I'm trying to get information from her, and it's very hard to get a straight question answered in a straight response. There's this kind of around the, you know, that kind of like around the corner. It's like, well, when are you going to do this? Well, we kind of don't. It's like the decision making.
Kind of. When you hear that word.
There's no sense of urgency. There's no ability to like do a math equation in your head. Like sometimes when I go to Whole Foods, I'll purposely give cash. And like if the bill's like a 1958, I'll give them like 2008 or something, just to see the puzzle, the faces. Like,
oh, I would love to do that.
Because they've never done math. It's always been on a calculator or a computer.
Yeah, but Mark, you and I come from the era where we learned our times tables. You know, to me, it was drilled into me. I mean, I can still do that arithmetic. And you don't need algebra in most things. Even in trading terms, I found that I don't even need algebra 99% of the time. Basic arithmetic will actually get you by most of the time. But most people cannot even do basic arithmetic without one of these freaking things. You know, it's actually quite scary to see how they cannot do it.
One of the best options traders I know, if you asked him how to solve a stochastic calculus problem, he'd be like, what the fuck is that?
Oh, kind of, me too. I'm the same as that.
He wouldn't, to him, it's like, what does that have to do with probabilities? I'm pricing an option off probabilities. This was a guy that was on the SIBO and the MX. He was making markets. But I guarantee you, if you told him to solve, you know, a differential equation, he's going to be like, I don't know how to do it. Why would I need to know how to do that? It doesn't have anything to do with probabilities, right? I'm not solving an equation here. I know in my head what something's worth and what people are willing to pay for it because of the probability of the market going down to that point. He doesn't need to be able to solve that equation literally.
No. The thing, you know, you were also talking about something really interesting that sparked another thought in my mind, and it's related to a conversation I was having with my partner the other day, where we were talking about the whole intensity thing, you know, in life, because people, I don't know if you've noticed, but even in markets, in training, in life in general, people in relationships especially are like, oh, I can't handle this, it's too intense, and or you're intense, or so and so is intense, or whatever. And we were talking about intensity, and she said to me, and I said to her, oh boy, you know, I've been called intense so many times before. And she says, yeah, that's a good thing. I said, really? She said, yeah, because intensity requires skill. She said, people default to their apathy when they cannot cope with any form of intensity. Intensity is just another word for saying I have capacity, I have skill, and I have passion. You know, and all these things. And one of the reasons why I think, and this is in politics, we see it in markets, we see it in training, we see it in a lot of areas, is that people lack intensity because it's so much easier to default to apathy than what it is to actually level up and become more intense. And I thought that was a really interesting point.
In the concept that I've found applicable to every area of life that determines between whether someone is good or successful at something and not is discipline. I was in high school, I was like a pretty average student because I didn't really care. I was into racing motocross and, you know, wrestling and playing lacrosse, and I didn't really care. And then once high school was over, like, oh, now I got to go to college, so now I got to get some discipline. And once you get the discipline, then you know, it takes, like any muscle, it takes a while to develop. But once it's built, it's like, okay, now I'm not going to be that guy down the hallway who's freaking out the night before a paper's due because he didn't start it yet. Because I started mine 3 weeks ago and it was done 4 days ago. So now I'm just sitting back going, hey, you want to go for a beer? You know, or, you know, I'm not going to study the night before. Once you build that in, and it's the same with trading, like that guy I was talking about. He failed, he blew up a few times, then he learned the discipline. And once he learned the discipline, then it was only a question of now polishing the side of it where, you know, learning how to let the profits run now. Because he already knows as soon as it gets to this level, he's out. It doesn't matter. He's out. He's disciplined. And same with training. It takes a lot of discipline. You got to do CrossFit. Those people are disciplined people, man.
And what does that have? Intensity. CrossFit is an intense form of training. Jiu-jitsu is an intense form of training. Trading is an intense game. You cannot operate at the highest levels without intensity. When people tell me that they can't handle intensity, it just is another way of saying, I can't cope. I haven't got capacity. That's what it really boils down to.
And society has essentially ingrained that in them with the short attention span. Everything is like, I watch my niece and they're just doing this with the phone. all day long.
Yeah.
There's no like getting into one thing, being obsessed with it, and taking it to the limit. I mean, look, I've studied all this. Anything that I get into, I get obsessed with. So I want to know, okay, how does this work? And okay, how are people doing this? And okay, well, could it be done better? And then saying, okay, well, what are they doing that's really ineffectual? How can I look at it differently? And there's just not a lot of attention span anymore. And that's why you see this abuse of Adderall. I mean, it's crazy. I mean, guys,
I think it's illegal over here as far as I know. I don't think
everybody, a lot of the younger people here are on it. And the older people on SSRIs, they're all hopped up on like Paxil and whatever other.
What are those? I've never even heard of those things, SSRIs.
It's antidepressants.
Oh, shit. I didn't even realize. See what I know. I mean,
well, look, if you really want to look at society and say, there's a big thing in this country, it's a left versus right issue with guns. But if you look at all these school shootings, most of those kids are on SSRIs. They were depressed. They put them on medicine instead of going and teaching them how to handle their emotions. And then they just found out that SSRIs, which boost serotonin reuptake, serotonin is not even the problem with depression, they found out. So it's like, what? So you got all these kids hopped up on this stuff, which numbs their feelings. Oh, gee, I wonder, now they get a hold of a gun. They didn't learn how to manage their emotions. So now they're just snap and they go into school and shoot people. And they never talk about how many of those kids are on SSRIs. They never talk about it. To me, it's not a gun problem in this country. It's a mental health problem.
Totally agree.
What happened is somewhere, I don't know if it was in the 70s, 80s, 90s, whenever it was, we as a society didn't learn how to exercise our emotions properly. I mean, if you look at a program like Alcoholics Anonymous or any Narcotics Anonymous, any of those things, what they really focus on is you need to be able to release emotions with either crying or laughing. So there's a lot of schools out there that teach you how to think and memorize stuff and go back and learn things, but there's really nobody out there teaching how to manage emotions properly. So what happens is people that don't know how to release emotions have them bottle up, and then something snaps after a while, and it's really, there's just nothing out there teaching you how to manage them. And now what we have is, it went from suppress all your emotions back in the 80s and 90s to now your emotions are everything. So just feel free to ignore logic.
Two tail ends.
You need emotions to get motivated to do something, but then you also need the logic. So, we're human beings, we have to handle both. We have to be able to use both. And if you do it properly, you get the synergy where 1 + 1 = 3. It's like, I always have this conversation and this argument with pure quants. I had this guy one day, I'm trying to explain to him about the term emergence, how 1 + 1 comes together and makes 3. And he's like, I said, I bet I can prove to you that 1 + 1 = 3. I'll bet you X amount of money. He's like, no, it's not possible. I go, it is possible. I go, how old are you? And he said, 39. And I said, all right, well, 40 years ago, your parents went on a date, your dad got lucky, and then 9 months later, you were born. How many people is that? And I'm like, in one context, that math works. If it's 1 penny + 2 pennies, then it's really only going to be 2 pennies, right? Because it's not a complex system, it's a simple system. So it's like, you got to learn your emotions are useful, but they're not the truth, because I remember working on a desk once where I got to shut the door again. He's barking.
Okay, go for it.
One of the guys called up from the floor, and it was back in the Enron days before I went to zero. It was a specialist. One of the specialists called up, and John Mulhern says, he goes, yeah, this guy wants to buy Enron. And his other partner goes, tell him to roll over, the feeling will pass. The thing with feelings is they're fleeting, right? They come up through a situation. They were designed to get you from not getting eaten by some creature in a cave. So, alert, danger. Now we're working with computers. So it's like, these are kind of artifacts, these emotional reactions, We have to just recognize them, say, okay, is this a useful emotion, or am I just reacting from genetics? In fact, my first boss, he had a rule, because like I said, he was one of the best knife catchers in the business. He said, if I puke in the bucket, double the position. Meaning it's telling me, like, now we had to stop. I mean, this is before it hits a stop. But if it's making me sick, my body's telling me I should get rid of it. But is that just because it's a genetic algorithm that's warning me of some danger, just because it's how we were designed to survive as cavemen? And sometimes the stop would get hit, maybe 30% of the time, but the other times it was the right thing to do. But your body and your human emotions are telling you it's wrong. I need to get this pain. I need to eliminate this pain. In CrossFit, you have to manage the pain and be able to cross those thresholds.
Oh yeah.
Same with anything, like surfing a big wave. Like when I first went to Hawaii, when I was in my 20s, I would paddle out and I'm like, Jesus, this wave is huge. And like, there would be like 7-year-olds laughing like these are ankle slappers, you know? And then, you know, year after year you go, it's bigger. And then you're out there and you'll see a 20-foot wave, 20-foot face, 10-foot Hawaiian, you know, you'd be like, okay, you know, as long as I know where to be, I'm going to be fine. It's okay. It's the experience. Now, I'm not getting the same emotional reaction from that same wave today that I had 10 years ago.
No,
right?
Of course not. Why would you?
The problem is we're allowing these people to have the first initial reaction to things. That's their emotional reaction. They think that's the law. It's not a good predicate. It's a mistake.
It's actually, yeah, it is a huge mistake because also I mean, I know this is going to sound very simplistic if I say it this way, but there was a time where men used to be men, you know, and I know some people will hate me for saying that, and I give a shit about that in any case. It's like, ooh, hate me for all you want, but I'm not saying about being emotionless. I'm talking about men being men, you know, where we could actually go and chop wood. We could go and build stuff. We used to build things, you know. Look at New York. New York is a prime example. New York was built by men, you know.
Yep.
The space shuttle, the Apollo missions were built by men and women who were supportive in those roles, you know. It's not about the whole men are better than women or blah 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 blah, but I'm just saying that you look at how effeminate men have become in today's day and age, you know. It's actually quite staggering to me to see how that's actually happened, and it's no wonder why we have so many disenfranchised people. I think that has had some correlation with more school shootings, as you said, or more mass shootings, or more disenfranchisement where people are looking for movements that they can belong to, because like, fuck, you know, I can't survive on my own, so let's find other people who are as disenfranchised as I am to go and...
Yeah, I think what happens is and especially in a digital world that we've become, it's so much easier to be individualized as opposed to a group. When I was a kid, I remember like 5th, 6th grade, we would play like King of the Hill. We'd like be grabbing each other, throwing each other off the hills, but we were all friends. We'd get in fights, but we were all friends. You know, it was just kind of like, you know, pecking order stuff. And, you know, it was good natured stuff. But now you'd be considered a bully if, I mean, look, there was always the biggest kid. I mean, he just happened to be bigger than everybody because he had some weird genetics, right? In 6th grade. So he could take everybody and launch him off the hill. But now he'd be the bully and like they kick him out of school, you know? We were all like, I mean, we weren't all best friends, but we were all friends. And, you know, some people, you know, were lower down the pecking order. It's just, there's a pecking order in the world.
I think trading shows that. trading shows that quite hectically, is that there is a pecking order in this game. And you can see it on the training mats and those things too. It's like the belt system, for example. You know that if you're a white belt and you go up against a black belt, you will get smashed. It doesn't matter how big you are or strong you are going to get smashed. And you're okay with that because you know that it's part of your progression. It's like what Carl Jung always said, the fool is the precursor to the savior. You know, so the whole idea behind the savior, and people think of this in a religious context, it's only one context that we could be talking. Once again, context. No one fucking talks about context anymore.
No.
You know, but
that's the problem.
But that's the thing though. So the savior can be your higher self, or the level of mastery that you achieve, where you save yourself from your ignorance. You save yourself, you gain knowledge to save yourself from lack of knowledge. And it's the same kind of thing. And the thing is, in order to gain mastery in anything in life, you have to accept that you will be a fool, but more importantly, you have to be willing to be a fool. The willingness to be a fool first is the most important step towards mastery. And that's the most uncomfortable one, because why? No one likes feeling stupid. Even those people who go through it, no one likes that feeling.
Yeah, and the quickest way to get good and successful at something is to be able to minimize your ego as fast as possible.
Oh yeah.
Because if you can put that aside and say, look, and this is why I think a lot of people have trouble today in this day and age. People want easy. They don't want difficult. I've always tried to do the impossible and come up short almost every time. But I was always attracted to the difficult, not the simple. And everybody now wants to get rich quick. They want to get in shape without working out. They want to, I want to run the desk before I've even, been an assistant. I mean, I was lucky when I came into the business that it was kind of an apprenticeship game still. Right. It wasn't a training program, but I worked for a senior guy, and I was surrounded by senior guys, and I was smart enough to understand that I should listen, watch who the good guys are, what the best guys are, and what they're doing and how they're doing it, and see what I can take from that it fits with my personality. And then, okay, then you get more responsibility. But they don't want that. They want to, and it's partly it's the fault of the employers. Like there's firms now that are pulling kids out of master's degrees from, MIT, Caltech, bringing them to work at trading firms and saying, here you go, we're going to pay you $400,000, go make money. And it's like, how are they going to make money? They don't know anything.
No,
they know some mathematics that has nothing to do with reality. So you're setting these people up for failure, and most of them have like a 2-year career. They're at a firm for a couple of years, and they either get stressed out and can't handle it, or they don't make money, and then they just get flushed. I mean, look, I worked with guys that decided to go work at firms like Millennium, and they started him with 50 million. He made money. They brought him up to 100 million, made money. They bumped it to 200 million. He started losing money, and he was gone. That's the game. It's
and it's a ruthless game. It's not an easy game. This game
very difficult.
I mean, I've seen that intelligence is not enough to get you overly far in this game. Not even close. You need grit. You need tenacity. You need adaptability. And as you said, the key thing that you mentioned over here, and I'll bring it back to training and all that stuff once again, is you have to kill your ego. Your ego, it's like in this movie Limitless. It's one of my favorite movies ever, where Bradley Cooper's character was talking to this group of people, where he was saying that the single biggest cause of failure in any society or any person has always been overreaching. Whenever people overreach, that is where we tend to screw up big time, because what causes overreaching? Hubris.
Yep.
It's always the freaking thing that hubris is what causes it. You don't take that, you don't allow your stop to get triggered. No, I'm going to ride this out a bit more. Then that 5% becomes 10% or 20%, 30%, then 50%. It's happened to all of us in some way or form.
Yep.
All of us.
the one thing I found, and this wasn't an original idea of mine, I had breakfast one morning with a guy who I read that said this. What's it? Vic Brandio. A friend of mine is a broker. He's friends with Vic. So I went to breakfast with him one morning. And I remember in one of his books, he mentioned about he tried to train some traders, and he had really brilliant people, a guy with a PhD from MIT, a guy that was in the military. And he said he found no correlation between intelligence and trading profits. He said average intelligence was enough. He goes, but it was emotional discipline, which is stop losses, right? And so every guy that I know who's been really good at trading, and I've worked with guys who, like I said, really like 20 years, never having a losing year. I mean, tremendous. That's what they were really good at. They were very emotionally disciplined. Now, after they took the position off, they might go break a phone off the wall, but that's the position's already flat at that point, right? Then it doesn't matter. But like in the one guy I know who, he's probably the best macro trader I know. He could be losing money and you wouldn't even know it when you're talking to him. Jim Leitner, he ran Falcon. Jim was a martial artist. He does Aikido.
That's very stoic. Wow.
He has a dojo in the office above. The office is nice. He's got his own little office. You go upstairs, there's a kitchen with the dining room, and then outside the dining room there's a dojo where he does Aikido. Really, like, he's the nicest guy you'll ever meet. If you ever met him, you would never think this guy's, he used to run multi-billion-dollar carry trade positions when he was at Bankers Trust. I mean, he's just such a nice guy. And he developed a strategy where, he doesn't have to worry about mismanagement, because he'll buy like a 1-year option. And as long as it trends enough, it'll pay for the premium he paid, and he's got a built-in risk management system, so he's never stressed out. And if he really just wants to play around, he'll play around with like a position so small that it's meaningless. But he's the type of guy that, like, you don't know if he's just came back from winning $1 billion at the lottery, or his wife just died, because he's just constant. Like, his emotional level is just the same. He's enthusiastic, but he's not like overly anything. Really, really, he's one of the most amazing guys I've ever met. And he's got some amazing stories of, he made a bunch of money in Russia when it transitioned away from being the USSR. He actually he hired guys, a lawyer, to go over there and sit outside these companies and offer them US dollars for their shares. And they were just giving them to him, like, US dollars?
Oh,
he
yes.
just he got out of top, and he's just a really brilliant guy. And then I also worked for a guy who was the head of rates at Moore, and he was probably the best intellectual macro analyst I ever met. But the firm, when he started, it was supposed to be him and another guy who was more of the risk taker. He was the head of liquid markets at Goldman, and they had worked together at Goldman. But he left, so he wasn't there. So this guy was more about the idea guy, and he was running the portfolio, and it wasn't his skill set. He was really, like, he knew the data 8 levels deep. Like, if the news came out, he'd be like, oh, this headline data, they're going to think it's good, but it's really bad. So he'd try to pick them off, and they wouldn't trade with him anymore. But his skill set wasn't emotional discipline. This wasn't what he was good at. Yeah. So it didn't really work out. But he was a brilliant guy. It just, the emotional discipline side wasn't his skill set. So he struggled, and he ended up shutting the firm down. And, the 2 clients were Goldman and Moore. I mean, these were top shelf guys. This guy was a top shelf guy. It just, he was really good at coming up with the ideas and knowing what was going to happen. But once you put that position on, it's emotional, even if it's systematic. Your subconscious knows it. And when you're asleep at night, you wake up at 3 a.m, in a cold sweat, something happened in Tokyo. You don't know what, but something happened.
I wonder if that's what Jung referred to as the whole collective unconsciousness too. And the reason, and the reason why I mentioned that is my dad told me this story many years ago. Well, this was actually long before he passed away, come to think of it. I think I was still in high school, and he was a big fan of Jung. And he told me that there was an experience where Jung went to one of these African countries. I think it was Kenya or Tanzania, somewhere around that part of the world. And he went to this church or monastery or somewhere it was, and there was this guy sitting there rocking in his chair like this, and he was mentally ill, so he was non-communicative, but he could talk. And the translator was pretty much relaying what he was saying, because all of a sudden he was rocking and then he stopped and he said, "Oh, now I know where the wind came from." And then Jung asked the guy to explain, what did he mean? He said he was looking at the sun and he saw these two elephant trunks swinging back and forth. And Jung realized, oh shit, this is big, because that is an ancient Greek myth or something about the two elephant trunks swinging to create the wind. And he was looking directly at the sun, and he said there is no way that this man in this part of the world had any exposure to that particular knowledge that was from ancient Greece. And that's where he said there has to be some form of collective unconsciousness that actually connects us at a far broader scale than what we fully realize. And I thought that was fascinating.
Yeah, I'm not a big Jungian, but I do believe that our intelligence is a dualistic system, where there's some of it is in here, but it's more of a receptor, and then there's information everywhere, and it's coming in and going out. So it's like I've had too many weird experiences where I knew something that I should know, or I started getting this information, and sometimes it's not mental, it's physical, right? It's physiological, because your body's much more abstract. And like I was working with this woman who wrote a paper about how Soros used to get a back pain before if something was wrong in his portfolio. Well, she actually was into the science of this, and she had an apartment off of Central Park, and she brought me through these sessions a couple of times, and it was kind of like she would have you visualize, your portfolio, and then say, how are you feeling about that? And this is when feelings really were kind of useful, because if all of a sudden you noticed you're thinking about your portfolio and your heart rate started going up, you're like, well, gee, that's kind of weird. But if you were thinking about your portfolio and you were like super relaxed and like, I'm just looking, I can see like calm rivers. There's something weird, because we're all connected and everything's connected somehow, because from a quantum physics standpoint.
Yeah, I agree.
And I think that's where the duality on Wall Street cracks, right? Nassim Taleb says it's not physics. It ain't physics. Well, I've kind of adapted that to, it ain't classical physics. It might be quantum physics, because like with Soros,
your camp.
Called it this quantum fund. If you look at something and you observe it and you alter it, well, that's going to change it, right? It's not like an engineering project where I've tested steel and I know how much weight I can put on it and it should survive for 2,000 years. Then I can optimize that mathematics, right? Because that's linear. That's stuff that's
mediocristan mathematics versus extremistan mathematics.
But in the real world, anything that is adaptive and evolving in using inputs, you've got to take as much information as you can. I mean, like, if it's going to be something that comes to you, like I've had, who's the comedian, Robert Wright, what's his name? He's the guy that he's kind of bald. He's got hair on the sides, and he makes these observations. And he was talking about his process. And he's like, all I do is I kind of look at something. I go, oh, that's a roll of tape. He goes, and then I just plant that roll of tape into my subconscious, and then I just forget about it and go do something else. And he goes, and then maybe the next day or a couple of days later, something will bubble up and say, why is it a roll? Why is it not on this? Or, so he'll come up with some weird like observation that he's learned how to use that programming of his subconscious to solve a problem, but it's not really a problem for him. It's a way to generate a joke, but I used to do this quite often. I would have a problem I was trying to solve, and if I didn't have an answer to it, I would think about it, and then I'd say, oh, I forget about it. Like if I was studying math, because math is pretty finite, right? You get stuck on something, and you have to go to get to the next level. You have to learn it so you can go. It's very hierarchical. And I'm like, well, I'm stuck here. So I would just forget about it. I'd go do what I'm doing or go to sleep or whatever. And then sometimes I'd wake up and I'm like, oh, now I get it. It would come to me. Because if you're trying to get the answer, you're never going to get it. Right. Or if you forget, oh, I can't remember where I put something. So I think, okay, where are my keys? And then I say, oh, forget about my keys. And I go attract my conscious mind, watering the lawn or something. And then boom, the keys. Oh, you left the keys in the upstairs bedroom. Right. So I used to play that game with myself, and there's something there that I think people don't give enough credit to, where there's something out there that you can tap into that's it might not be a memory or a tape in your head, but it's somewhere that you can bring it back. Because if you think about it from a quantum standpoint, it's outside of space and time, right? So if you can tap into that somehow, and they call it the gap in meditation, right? If you hit that gap, you lose track of time.
Yeah, I agree.
And it's like, I was meditating for how long? 45 minutes. It felt like a minute. So
it's kind of like it's like the relativity concept, similar to that.
And then it gets, you can get really wacky with like some of that stuff that Tesla used to do. He used to claim that some entity was telling him all the information on how this stuff works. And, maybe when he was born, he had some weird wires crossed in his brain where he could input that information. And he was definitely onto something, because he came up with stuff that was so far ahead of everybody. It was.
Oh yeah.
But I definitely believe in that, and I definitely think that's. Some people might call it a gut instinct, because it's usually physiological. It's not intellectual. It's not cerebral, right? Mm-hmm. It's probably coming from another portion of your brain that's more of a let's say an antenna that's collecting information.
Yeah, I think Gladwell calls it thin slicing in his book Blink. Where you actually start doing a lot of that, though. I don't know if you've also found this, though, but I can often relatively easily tell which kind of people I'm going to get along with and whom not. It's actually years of experience. When I was in my 20s, I had no clue, but now that I'm nearly 40, it's like I have a pretty good idea. It's like, even with us, over the years, we've had some engagements like, yeah, I'll get along well with Mark. We speak a similar language. We have similar values. There's far more value validation than value violation. Because at the end of the day, it's like what my NLP mentor and trainer said to me when and I know I'm slightly digressing, but this is all part of the whole mastery process.
It's just a circle, man. It all comes to the same place.
Yeah. He said that, whenever you get glad or mad, so to speak, you have to ask yourself one question: which value has been validated or violated? That's what it really boils down to at the end of the day, though. And this is also where you get along with people. You get along with people who validate more of your values than what they violate. Because let's face it, we violate many of our own damn values. None of us are perfect. I violate some of my own values. Sorry, go ahead.
We're the ultimate hypocrites. I have a saying that I always say to people. I said, I've met the enemy and it's me.
Yeah. pretty much. And I've just found that I prefer to engage with people not only who necessarily agree with me. What I love about talking with someone like you, for example, is that we can share ideas, and we can do it in a civil manner, a civil and civilized manner. Those are the two key words over here. And even if we have a disagreement, it doesn't mean you have to disrespect one another. Disagreement is not a synonym for disrespect. I wish more people would actually just get that. It's actually not a bad thing if you disagree, because that's where you learn something useful. That's where you level up. I've also said that one of the reasons why I personally think that many business relationships, many personal relationships actually get screwed up is because people adopt the language settle down. No, level up. Level up. If you look at the words settle and down, those are two of the shittiest words in the English language for improving yourself. you know, or improving any aspect of your engagement with other beings, other people, you know, at any kind of level. You want to level up. That's the reason why I'm talking to you. I want to level up. I'm enjoying engaging with you because I don't feel like I'm settling down. Fuck no, I'm leveling up. And that's the beauty of all of this. But not many people want that. They want what's comfortable, because it's like what Joe Dispenza says, that and I love Joe Dispenza's meditations, because he uses a lot of quantum mechanics ideas and all these things too. And he says one of the reasons why it's so much easier to just default to your problems is because it creates a predictable future, and that is comfortable. People can get comfortable in their own misery, which is like, whoa.
Oh, yeah. And the thing that I find, there's generally two types of people in the world. The people who are willing to accept reality, and there are people who think their views are right in the face of reality. Reality is what reality is. I mean, as much as I want something it to be 90 degrees in February in Boston, it's not going to happen. And if it does, we're probably not alive on this planet anymore. But you know, that's kind of where I end up bumping heads with people. If you're willing to tell me that reality is wrong, now you can be in reality and be frustrated. Like, I'm driving back from the gym today, and there's unnecessary traffic because people are sheep, and because the guy on their right hits their brakes, they're going to cause traffic for no reason. That's frustrating, and I can't change it, but I can complain about it, right? But it's still reality. I mean, my way of getting around it is bitching about it to myself. Okay, I vented, now it's out. Now it's out. I mean, but it's reality, right? And a lot of people, especially in this business, and especially because the accepted methodologies in this business are all about accepting reality when it fits and ignoring reality when it doesn't fit.
That's a big one.
Yeah, because it's, you know, you're trying to measure, you know, water with a ruler, right? It's you're using the wrong tool. And sometimes you can get away with it, you know, for a certain period of time, but
reminds me of Wittgenstein's ruler.
Well, yeah. Look, I mean, you got to understand the ruler, you know, and are using the right ruler. And people don't like to hear that they're using the wrong ruler because they're attached to it. I'm like, I said to this guy who's a professor at Harvard, I said, you didn't invent this stuff. Why are you defending it?
Yeah, totally agree with you. I totally agree with you on that, Mark.
You attached your personality to it, so now, you know, this is it. It's like a sports team. You know, you're a Red Sox fan for 100 years and you don't win you never win a World Series. Then finally you win one. Well, let me tell you, that's kind of okay because it's just a side thing you do for entertainment. You know, if it's your job, you know, and that's why if you look, I don't know what the percentage is, but like these real money mutual fund type managers, almost none of them even generate what the index does. And it's because they'd be better off just doing the index and charging a fee, which is what, you know, Vanguard does. But once they start getting active, I don't know if you read that post I did today, and I didn't just pick some people to pick on today. No. Did you read that post I posted today?
I haven't been on LinkedIn today, funny enough, so but I'm actually going to check it now afterwards.
There's an active commodities fund that Cohen & Steers runs, and over the last 10 plus years, it's underperformed the index by 100 basis points a year before fees. So 170 basis points a year. So that's 17% that they cost people. And I didn't just pick this fund out of the blue to pick on people. These are guys that were looking for someone to help them, and I offered to help them, and they rejected my assistance. So now you're fair game. You know, I looked at, I noticed the problem. I noticed what their backgrounds are. They're all the same guy. just different names. And they were looking at the same things the same way. And I'm like, I can help these guys. And so I offered to help. The guy kind of brushed me off, and they rejected my assistant. So now they became content for me. And I don't, I don't just, I'll never say anything negative about people who don't have it coming, right?
Like, I'll vouch for you on that one. I will.
I'm not going to pick on someone. Look, I'm not that smart. I worked for a guy who had a PhD from mathematical physics from MIT and a law degree from Harvard. He didn't last in the business very long, but he was the smartest guy I ever met. I'm not that smart, but I understand reality pretty well. So if I...
Yeah, but Mark, here's the thing, Mark, exactly. Sorry, I just had to say this because otherwise it's going to evade me. You have the ability to draw a logical conclusion. That's one of the big things in life that I find that differentiates smart from wise people. There are many fucking smart people out there. Many people with degrees in this and that or the other. But at the end of the day, the only degree that really counts is the degree to which you apply yourself, in my opinion. Because in any endeavor that you go, it's the degree to which you apply yourself and whether or not you can draw a logical conclusion. Because if you haven't got the ability to draw a logical conclusion, what good are you? What good are you for? Sorry, go ahead. Sorry, I had to get that in.
I like the term effective. Are you effective?
Yeah.
That way it removes all the whether there's connotations or are you good or you're bad? It's just, are you effective or not? It's pretty digital, right? You're effective or not. So I posted this thing today and I was like, I posted their fact sheet. I'm like, look, if I'm gonna offer to help you and you brush me off like, oh, you don't know what you're talking about. Yeah, well, maybe I do. Maybe, when we ran the strategy at Weiss, my former partner and I, in fact, he's in the most recent Market Wizards book. Like I said, when we met, we both viewed things contextually. That was how we got along. So we were friends and we collaborated for many years before we worked together. We tried to work together when Reverend Howard first came to New York. They were looking for more trend following. We were doing counter trend, so it didn't work out. But then we ended up working together at Weiss. So it's you gotta be able to understand the context of things. And if you tell me I don't know what I'm talking about, I've always, when I left Weiss, I just ran money for these two family offices using the counter trend, which is really hard because I have to be right when everybody's wrong. That's the only way I make money. And I was generating 195 basis points of annualized alpha. So 100% of my returns was alpha, right? If you were running a macro portfolio and you put mine on top of it, it was all alpha. So that's so hard to do. And I have guys that have generated zero alpha making judgments on me and saying, no, you don't know what you're talking about. What? Yeah, but I do.
Yeah, it's insulting. It's really insulting.
It's like, you can tell me, you're not going to fit in here personality wise. That's good. I'm good with that. Hey, okay, that's fine. You guys want to stay on the path you're on? That's fine. Obviously, your fund is jammed away somebody's 401k or IRA, and they don't even know that they're underperforming because they don't look at it. Because, okay, that's fine. If you're happy with that. But to me, I don't ever want to be associated with the stench of mediocrity. It's a stench. And
you don't get it out.
Yeah. And I've talked to a few people up here in Boston. I tried to help a couple of guys at a couple of firms and, try to explain to them how, you're looking at content in your parlance and I'm looking at context. If we use both, it's going to be much more effective. And they just don't want to have anything to do with it. So it's like,
I know, right? I know.
And I try to tell them, I go, do you understand? I mean, I know some of these guys whose names and they all take this very seriously. They all look at it. They're not just guessing. They're not just saying, we have a quant model that says this because of X. that's not how these guys became who they are, right?
Never.
You don't know. It's not random that you know their name. But some of these guys, they're getting paid a lot of money because they started at a firm, and through attrition, they got higher and higher up. And they're real money shops. They're not hedge funds, but some of them are trying to run absolute return portfolios. They're just playing, pickleball against, McEnroe. It's just you're not
it's
playing
like checkers versus chess,
it's
that kind of thing.
It's a different game, and it's just, it's oil and water. So I'm like, okay, this is obviously a personality situation where you're happy because no one's firing you because there's no competition here. So I get it. So it doesn't frustrate me. But when you do tell me, I had a run-in recently with someone who is at one of these type of firms, and he didn't show up for a Zoom. He passed off his second-year analyst on me. And I've been doing this for 10 years longer than the hiring manager.
Oh, boy.
So I'm like, and I don't mind educating guys. So I stayed on the Zoom with this guy for 40 minutes, the junior guy, just so if he had any questions, I want to help him think about things, right? I talk to kids that are trying to come out of college. I'm like, they're like, what should I do? I'm like, well, just beg, plead, and, cry and beg to get on a desk. Just tell them you'll go fetch coffee, right? Or if you want to get into a program or like entry level, go get a master's degree in a CFA just so you get through the turnstile and then forget everything they taught you. But it's like, this guy, instead of this guy coming back, I'm like, what happened? I emailed him. I said, dude, that was unprofessional and kind of disrespectful. I said,
It was actually.
So his response was to make excuses. And I'm like, oh, I get it. Now I know why.
Shit, not a good start.
Yeah, I go, okay, now, not like, sorry, dude, I got stuck somewhere, I'm going to miss it. And the funny thing was, he's contradicting what his assistant told me during the Zoom. I'm like, he's like, I don't know if he's going to make it. He's called into a meeting. But the story he told me was completely different than that. And even his assistant even texted him. He never responded to his assistant. So it was like, I'm like, okay, dude, let's be real. And I looked at this guy's background. He's not a Wall Street guy. He's not a hedge fund guy. So I get it. But they're deluded because they're paying these people a lot of money to do a mediocre job. It's a weird, the real money side of the business, the endowments, most of them, the pensions, the money, the mutual fund type companies, it's a weird culture of like, they're all the same dude with like a cheap suit and a bad haircut with an MBA and a CFA. And generally the process is you come out of undergraduate, you go to these firms, you're working like the middle office, they pay for you to get your MBA at night, you get your CFA, and then they put you on as an assistant. And then next thing you know, 20 years later, you're the head of the department. But like you have you're not even generating index returns. It's a weird, I never really, because my whole career was prop desk and hedge funds. So when I started talking to people up here in Boston, it was surprising to me how much money these guys are making for what they do.
I have a friend who's a programmer, and to build on to your point, he said that you often find people in the programming world who have gained 20 years of genuine experience, or they've only repeated their first year 20 times over. And I thought that is a very clever way of putting it, because what you described here is someone who's just repeated their first year 20 times over, and they actually ended up in a managerial position, or like they became a VP or a director or executive director or whatever. But they're essentially first years with 20 years experience. What use are you really in real world terms?
It's very strange. It's very strange because some of these mutual fund companies attempt to create these hedge fund products. And I've spoken to some of the people that are doing this, and there's a certain skill set when you're a mutual fund manager where you're kind of fundamentally based. You're making 3 to 5 year bets on big movements,
Yeah, yeah.
economic macro. That I understand. But when you're trying to run one of these absolute return strategies inside one of these firms, it's like you're going to a gunfight with a spoon.
You're pushing your luck. You are pushing your luck big time.
It's not. I mean, I know. I don't know like Alan Howard, but I know guys that are really good, and I know what they do and how they think, and it is not what these other guys think. And it's. I was really surprised that their level of knowledge that they think they have because of some arbitrary credentialing, and actually what they know. It was really eye-opening because I grew up here and I left after college, and then and when COVID hit, I started coming back, and I'm glad I left because I mean there are some really talented people up here, but they're in like specific type of firms like Bracebridge. They run a lot of credit and structured products. They're really good. There's a firm called Weiss Asset Management. They're really good at like Asian equities. They're really good at that. And they run hedge funds, these two firms. But there's other firms that are running pseudo hedge funds. And they're just, it's not macro. It's not like the people I know that are successful in it. It's just it's weird. It's a weird thing. And it's like, if you don't, a lot of it I understand. We're not going to connect intellectually, so I get that. That's fine. As long as you don't outwardly, insult me, then I'm not going to come back at you. But like today, I came back at this firm today, and I did one to another firm the other day. But normally, it's just you don't know what you don't know, right? And that's kind of your experience is narrow, it's not broad, right?
No, I fully hear you there, Mark, and I mean it's really fascinating getting your take on all of this though, because that's the one thing that I've always said about you and known about you. Ever since you and I were doing some consulting for what were they called again? Zyges. Yeah.
I forget the name. They were nice kids. They were really positive, and they were nice guys, and
I
they
don't know
me
what
to help them more, but I was going to take a job at the time, and I couldn't I couldn't be on a board of something, so I didn't do it.
I didn't, and also I can't remember. I wouldn't say we had a fallout, but we just had a bit of a disagreements about things, and we just didn't continue. But it's fine. I mean, no bad blood or anything. But I remember, even from those days, just the newsletters that you used to write and the comments that you used to make, and I thought, bloody hell, this guy, he's got a different take on things. Like you have a different lens through which you look at the world. And it's also that's why I was also so glad when you contacted me regarding this podcast episode, because I mean, look at us here talking about training and stuff, and how training comes into it, and how much of an anchor it can actually be to making you a better trader or better investor or any of these things, because it's a symbiotic system. It's not a siloed kind of thing. And this is what I often do find, is that many people think, oh, how the fuck could training probably make you better at trading? You'll be surprised. You'll be surprised how much it can make.
They're universal principles.
Oh yeah, totally agree.
If you can motivate yourself to go to the gym, push beyond your pain threshold, this is a discipline. It's just simply exercising discipline, and that is a universal tool for anything you do. You want to be excited about something, you want to be obsessed with something, you want to have discipline where you can focus on it, and then once you develop that tool, it's universal. And like, I tend to look at a lot of things like I use the same kind of model with fishing as I do with trading. It's the same thing. Where am I in an environment where it's easy to catch fish, and I can use the simple tools like kind of the middle distribution, or am I in an environment where it's going to be hard to catch fish and I have to get one really good one? Because it's the same because I understand the cycle is the same, right? It's orderly and then it's disorderly. So it's like, where are we in that, and what contextual information can I pluck? You know, I mean, you're obviously going to drive differently in a car in the rain with slick tires as you would in the sun with like the same tires. Right? Everything is contextual in the real world. It might not be in engineering, but we're not doing engineering as much as they want it to be engineering. It just, the past has little to do with the future in terms of patterns. Context has a lot, because the context always repeats. That pattern is the same. So it's like, if you can understand the context, then knowing the content's easy, right? Anybody can learn charts or fundamentals, stock, any of that stuff. That's all the stuff that they're teaching in school. Anybody can learn that.
It's true. But it's always your interpretation, because interpretation is the context, isn't it?
Yeah. It's how do you view things and how you act on it. And once you view it and act on it, that's the quantum side, right? So now you're saying, okay, I believe X is going up for Y reason. I'm going to buy. And then if it goes up, you go, oh, I was right. I'm going to buy more. And then from an information theory standpoint, you start creating a signal, right? Because the information becomes signal. And you say, okay, so now there's less randomness and more information and signal, the more I'm going to act on it. And then other people see it, and you get a networking effect. And it's not just markets, it's fashion trends, it's traffic, it's viruses, it's weather storms, it's everything. I mean, normally, you know, you don't get one day of storms, it's a few days, and then you get sunny for a few days. And, you know, there's these little movements that are not random, right? They're path dependent. And I think a lot of people don't grasp that path dependent is a consequence of either, you can call it initial conditions or context or necessary conditions, or, you know, I read a thing the other day from, what's the guy's name? McClellan. He's the son of the guy who created the McClellan oscillator. And he said he had some chart up where he likes to find correlations, but he said, this is not a signal, this is a precondition. Context, right? Okay. I said, this is key. And almost everybody misses this. The preconditions are more important than the content. The context is the most important, because the content affects the context, right? Yeah. Because they're symbiotic. They're moving off of each other. So it's like, and I try to explain this to guys who are not like hedge fund types, and it just doesn't go over. They want to talk about earnings or, you know, interest rates, you know, or like one guy, I said to him, we were talking back in 2019 in September, I think it was, and we were talking about interest rates, and he's like, I said, yeah, but they had, I think, 5 interest rate cuts priced in or something. I go, you weren't getting 5 cuts or whatever it was back then.
The rates were too low for 5 cuts anyway. I don't know how the hell you would get to that point.
It was whatever it was, but he said, well, what if it kept going? I go, but you weren't getting that. I go, they already priced in more cuts than we're going to get. So by definition, you would be the last guy making that bet. And then the music stopped, and there weren't enough chairs. So these people just cannot grasp that the rules change based on the actions of him and everybody else, because that doesn't align with the poker or the modern portfolio theory or the, you know, Graham and Dodd, you know, oh, we're picking earnings, but the earnings, the price of the stock affects the earnings. I mean, it's not, you know, it's not that simple, you know, but you can't be philosophical with engineers.
No, I've actually noticed exactly that same problem that you just mentioned over there also. And I do think that, you know, and, you know, I could actually carry on talking to you all night, but I think we need to have another conversation, you know, at some other points too, you know, because this one's actually getting quite long, come to think of it. And it's
I just looked at the time. I lost.
No, but once again, it's that gap effect.
Like
But it's that gap effect that you were talking about earlier. You know, like we get into things, and it's a gap effect, and it's the relativity effect that kicks in now. But the one thing that I think that you'll appreciate too, and you're a smart guy. I mean, like, I don't think either of us are fools over here, but there is such a thing as the curse of intelligence. And it was pointed out to me during some seminar or whatever it was that I was watching or reading. I cannot remember. This is years ago, where the guy said that three of the most dangerous words that you'll hear from smart people are, "But I'm right."
Yeah.
You know, "But I'm right." So why did you lose money? But I was right. You fucking lost money, you know, but I was right. And that's such a common phrase to use. And
yeah,
it's actually ridiculous.
My first boss asked me a question, and it took me a long time and I struggled with it. He said, it's very simple. He goes, "Do you want to be right, or do you want to make money?"
Or both, if you can help it.
Well, no, but generally speaking,
yeah.
If you're making money, you're right, incidentally, but sometimes you want to be right and you're losing money, and you stick with the position because you want to be right. And that's a hard thing, because if you're operating, everybody gets what they want out of the markets. I think Ed Seykota said that. And people want to be right, and they don't like being wrong. And it's that ego attachment. And the guys like that have the lowest egos, you'd be surprised they're so successful they are. I mean, look, Jim Leitner, I'll go back to him. That guy has no ego. I mean, he's unbelievable. I mean, the nicest guy. It's like, you're in this business with all these assholes and you're this nice? Because trust me, I've been in this business a long time. It is chock full of scumbags.
Most Wall Streeters are idiots and assholes in any case. I've met quite a few in my life. And I've often said this, and I don't know if you can relate in any way, but I'll relay my thoughts. I love the game, but I don't always love the people in this game. You know, it's something that I do find is that many of the people in this game leave me very unimpressed, to say the least.
A lot of them are in the business for one of two reasons. One, because they want power, and to get power, the easiest way to get power is through money.
Yeah.
And then other guys want to be known. Like, I worked with a guy before who was not that smart, went to a less than average school, who did very well for a period of time, but the money, he wasn't really into the money and the power. He just wanted to be known. And he got more well known, and now he's occasionally on TV, and that's really what he was searching for. And so guys they want power or fame, I think. To me, I'd rather be infamous and rich.
Oh, me too. I couldn't give a
Nobody knows who you are, and you have enough FU money where you do whatever you want, whenever you want.
Oh yeah, it suits me. It actually suits me, because the last thing I want to be is a target in any kind of way. And I don't want to have a target painted on my back either, because the reality is that the more you have, the more people want to come at you. It's just the reality of life. You can't escape that.
Everybody likes to bet against the the guy that's sticking his chest out. And that's a friend of mine, my friend Hari. He does one of these podcasts for Top Traders Unplugged, and he's like, anytime you want to come on. And I was like, well, I don't really want to come on and just strictly talk about markets, because this was interesting, because we could talk about the universality of creating a discipline and a focus in other aspects, surfing, martial arts, markets, because it's a universal thing. But just talking about markets is kind of boring to me.
Me too. I agree.
Because then you start to have someone ask you, well, is ABC going up or down? And it's like, well, it's a more complicated conversation, right? because the MBA talk is what's the bottom line, what's the Sharpe ratio. Whereas I may say, well, there's a high probability that it's, it goes up a little, and a low probability it goes down a lot.
And the other thing is also, the other thing is also, Mark, is that we're not competing with one another. There's no clash of egos going on here. No one's trying to outdo the other in any kind of way. And that makes for a great conversation, which is not what you always find in these kind of settings in any case. It's like, Chris was telling me that one of the reasons why he doesn't go on podcasts anymore is because some dipshit guy, and I'm actually going to use that word in very strong terms, try to catch him out in some kind of way on this podcast, and he said, and Chris actually said to me, he said, look, man, I'm a trader, I don't know about all the legal ramifications of this and that. And he said the guy pitched something to me, and he said he did it in a very roundabout way, but then the guy was like, oh, look at how I caught out this volatility trader. And he said, dude, you know me, I'm not someone who is an egomaniac, and Chris is not an egomaniac. I can vouch for him 100%.
Yeah, he does MMA, you can't.
No,
there's always someone better.
Yeah, exactly. And he's very good at both disciplines. And he said, but this guy went out of his way to try and humiliate me and this and that and the other. And, it got me into trouble with compliance. And I just thought to myself, but what's the point of having a guy like him on the show? If that's all you want to do to try and get clicks, that's not the purpose for me to have conversations with people. I want to learn cool stuff and share cool stuff.
And that's why Joe Rogan is so good at what he does. His guests always say, it's been 3 hours?
Yeah.
Because he asks them questions, and then they talk about interesting stuff, and he kind of, he has his view on things, and that's cool. And the other person has their view, and it's a conversation where you get very little of these dead air, because everybody, the people are into it. They're going back and forth. There's a tennis match. They're talking. No one's trying to trip anybody else up. Occasionally he gets a dope in there that tries that, but he's good at muting it. But it's like, there's a reason that guy's so successful. He's a very disciplined guy. He understands how the model of success. It's hard work, it's focus, and it's discipline. And the rest, he brings up Musashi, right? Have you ever read the
Book of the Five Rings? Yeah, I know of it. I haven't read it, but I know of Miyamoto. Brilliant martial artist.
Essentially, he said, if you know the way broadly, you see it in everything, right? So it's a universal principle. If you understand the universal model of, you got to be focused, you got to be excited about something, you got to be obsessed and focused on it, and you have to be disciplined.
Yeah,
if you can follow that process, it doesn't matter if you're trying to be the best backgammon player in the world, or you want to be, the top supercross racer. It's the same thing. It's all about focusing. What am I weak at? What am I strong at? I'm going to focus on my strengths, but I want to try to bring my weaknesses at least up to average. And I have to be obsessed with it until now. I don't even have to convince myself to do it anymore. I'm just naturally inclined to go down that route.
Yeah. And it's interesting you brought up Miyamoto Musashi, because that guy was a beast, to put it in plain, simple terms. To anyone who doesn't know who he was rated as arguably the best swordsman in Japanese history. To put it into context, he could fight with a katana in one hand and a wakizashi in the other hand. And he beat every single opponent he ever faced. I think he retired at something like 32 or 33 or whatever it was. And then he just went on a path of enlightenment afterwards. But he busted up anyone who ever tried it with him.
Yeah.
Badly.
And there's no, generally speaking, you can't lose a fight because you're dead.
Yeah, literally.
And just to cap this off, when we were talking about the universality of the conscious mind, the subconscious mind, and how it's. I read a book once. I spent a lot of time. I was like kind of a minor in philosophy in college. I read this book from this Dutch guy it was called The Empty Mirror, and he went to Kamakura, Japan. This was back in like the 1920s or 30s, and he had to take a boat back then. There was no planes. So he took the boat all the way to Japan from the Netherlands. I think it was, the Netherlands. Got there, he was in this program, and every day he would do his meditating, his cones, and he get whipped by the instructor. And he kept trying to, he kept asking the instructor, what is Zen? What is Zen? And, there was a story about, well, the master threw his student into the river and said, now you're swimming in it. And he kept intellectualizing it. And he was there for, I don't know how many months, or maybe even years. I forget the amount. But he finally said, okay, it's time for me to go. I never really reached the enlightenment I wanted to. So he got back on a ship to go back to the Netherlands. And he had to work on the ship to pay for his voyage. So he was sweeping the deck, and he swept this rock, and it went flying, and it hit a metal gunnel. And it came to him, and he said, oh, now I get it. And he couldn't get it in the monastery. But when his mind was occupied with the brooming, and then just that noise of it hitting something sparked it in his brain, and it hit him, and he goes, oh, now I understand it. It's about embracing the process. My trip was successful, even though
fall in love with the process. Yeah.
My being at the monastery was a failure, but it all came to a conclusion on that one sweep on the deck of the boat. That's kind of, it was that, to me, that was amazing, because it's like, it's really, the reality is out there and it's available to you, but you can't get it by thinking about it, right? Mm-hmm. You have to plant some seed that wants some water, and then this collective consciousness will water it, and you'll get that sprout.
To end it off let's end it off with this particular one. It's like this old saying, good things take time, but great things often happen all at once. And that was exactly one of those kind of things. So the good thing of learning what Zen is took time, but then whack that thing, and the great thing happened all at once.
It's because reality is both linear and non-linear.
Oh yeah.
And if you can understand that, then you can function through life, because otherwise everybody wants it to be linear, where I work hard and I get ahead. It's not how it works.
Not how it works, I'm afraid. Mark, it's been...
What time is it there? It's got to be early in the morning.
It's 2:47 on my side.
You should have cut me off hours ago.
No. I wanted to talk with you about this, though, and it's fascinating. It's such a pleasure to talk with you, and I would love to have a follow-up conversation sometime, because it's just, I feel we haven't even scratched the surface of everything that we can get into. There's so many more other aspects of training and stuff, but this was such a good conversation. I mean, I really appreciate your time and just your inputs, because I learned so much, and anyone watching this, I just think would go, frig, I don't even need to go to university anymore. I just learned.
Well, the problem is you need to get through the gatekeepers, and that's what I tell the younger guys. I'm like, look, get a job in the middle office, let them pay for your MBA and your CFA.
Yeah.
So you click the box and then you get in there. Otherwise, it's going to be real hard, because it's not like it was in the 80s and 90s, where you can go as an assistant on a desk, be kind of like absorb things and be an apprenticeship type thing. It doesn't work that way anymore.
No, my friend Darren Sinden is a well-known trader there in the UK too also, and he said that if he had to apply for jobs nowadays, he wouldn't be able to get one anymore. So it's
a shame. Like I said, Balyasny would not hire Dimitri right now. And he's the guy who created the whole thing.
Yeah, it just shows you.
Shame.
It is what it is, Mark. But you know what? Let's have a follow-up chat again sometime. I would really, really enjoy that, and enjoy the rest of your evening. It looks like it's what, 8 o'clock on your side or something like that.
Yeah, I'm not doing. I have no plans tonight, so I'm good.
Okay. Thanks a lot, mate.
I appreciate it. It was a great conversation. Next time we'll find a different topic we can obsess on with the same universal principles.
Perfect. Looking forward to it, man. Have yourself a good one.
Right, cheers.
Enjoy evening.
Cheers.
Bye.